Good morning to our wonderful audience, and thank you all for joining the third day of the BCI Offshore Investment Managers webinar. It's great to have you all with us again this morning, and thank you for your continued support. On screen now is the agenda for today, where we will again cover a lot of ground on global macro, value, quality, global property, and emerging markets. All presentations, as usual, are being recorded and we will share that on the Boutique Managers website. As always, you're welcome to post questions in the Q&A bubble, and we'll try to deal with those questions after each one of the presenters. The managers this morning will continue in covering some of the very topical issues that's ongoing, like the impact of tariffs on growth and inflation in major economies like China, Europe, and the US. Some will argue that parts of developed markets are expensive, while others will identify attractive opportunities remaining in the US. We are seeing new deals being forged between China, Russia, and India, and this could very well be a possible area of exceptional growth. Who knows? Key, I think, will be to employ fund managers that can actively seek opportunities in various markets in well-diversified portfolios. Our aim from the BCI team side is to give you exposure to these top quality managers with proven track records that can make a real difference in client portfolios. We're kicking off with global equity, and we're being joined by a gentleman that needs very little introduction, Andreas van der Horst from Mazi Asset Management. Good morning, Andreas. How are you doing?
Eugene, good morning. All good here.
Always great to have you with us. And we are ready if you are. Andreas, again, thank you so much for your time. It's always great to have you.
Thank you, Eugene. Tanya, Olga, BCI team, thank you again for the opportunity to be here. We always deeply appreciate it and value the support of the BCI team. Ladies and gentlemen, good morning. Today, we are going to talk about quality investment and how it really does compound your wealth. Next slide, please, Dan. No doubt a number of you will recognize this famous painting by Rene Magritte, a Belgian surrealist painter. This is not a pipe. This picture is deceptive. I want to believe it's a pipe, but it is not so. It is not real. It's just a representation of a pipe. And so too it is with long-term investments and the keys to compounding your wealth. Most investments purport to be a sure route to compounding wealth, and many stock and investment ideas will cross your desk. But when your objective is to grow wealth, few of these ideas really are. Most of them are just not real. It's not a pipe. Next slide, please, Dan. Before we get into the nuts and bolts of today, let's preface Mazi, our philosophy, and our approach. We've been around. Next year, we indeed celebrate our 20th anniversary. We strive to be a diversified, ethical investment manager that draws on the best talent that South Africa has to offer. And we have a single-minded focus to grow client wealth through relevant investment solutions. We launched our global equity capability in 2020 with a team of highly experienced investment professionals. We have decades of combined global equity experience. And our day-to-day fundamental work and portfolio management is strongly underpinned by our proprietary data analytical tools. As a firm, we now manage about 51 billion in client assets. And as it pertains to global equity, we now do 3 billion in assets. Our global equity team is heavily invested in our fund. Ladies and gentlemen, we've got serious skin in the game. The results do matter to us. Next slide, please. For good order, especially in this volatile world that we live in, let's just briefly revisit our quality philosophy. Firstly, we want to own businesses that are run by teams with exceptional integrity. Ultimately, as shareholders, we are entrusting our assets to a company management that needs to work in service of a customer for the benefit of a shareholder whilst managing all the other stakeholder issues that come along. Secondly, we want our managers to be exceptional capital allocators. That means the use of the company's assets and the shareholders' funds happens in a highly productive, profitable, and sustainable manner. each decision that these management teams make must be economically sensible and lead to even more profit down the line on the dollar invested in the business. Thirdly, our businesses must have a competitive edge or moat. Typically, these things are strong brands, distribution networks, unique technologies, recurring subscriptions, and the likes, but things that make it difficult for others to compete and enter the business. But all of this is not enough. We look for a competitive edge that, in fact, sustains and accelerates growth. And this is the key. And when we find it, that thing becomes visible in high returns on invested capital and persistent production of economic value add. In other words, a surplus for us as shareholders. And lastly, ladies and gentlemen, this is the clincher. We want to own businesses that are good for us as shareholders. We're not in any other business. We are in the shareholder business. There are a great many businesses out there. Some are wonderful to work for. Some are wonderful to tax. Some are amazing for the customer, but very, very few businesses are actually good for us as shareholders. We want to be busy with those businesses that are good for us, not the rest. Now, when we put all of this together, and these aspects must all be there and work together, we look for the best growing quality businesses in the world, and we want to own them for a long time. But ladies and gentlemen, this is not a buy and forget strategy. Every day, a ton of work happens in our office and within the Mazi team to ensure that we have the right horses running the race, that the moats of our business keep on widening, that the growth is there, and that management stays on track. These companies that we own must, on an ongoing basis, continue to meet and exceed our high-quality investment criteria. Quality investment, ladies and gentlemen, is not inactive investment. When you have a quality portfolio actively managed for the long term, you can really compound your wealth. Next slide, please, Dan. Let's take a look at where investment returns come from. The chart is far less complicated than this seems. I'll walk you through it. These are US dollar numbers, quarterly rebalanced. On the very left, we have the equity portfolio, so a passive portfolio investment. There you do about 1.92% in dollars per quarter over the long term. So you times this by 4, you get about to 8%. And if you want to fact check that, the long-term equity number for returns is 8.6% in dollars. If you step to the right, you get an equal weighted portfolio, and there you'll do quite a bit better than the equity for the simple reason that good stocks that are small are not penalized for being so small, and large stocks are not advantaged because of their massive market cap in the index. Now we get to the meat of it all. We step through growth, momentum, quality, and value as individual strategies, and when these things are executed perfectly, you are likely to do a better job than the benchmark. We, however, operate in the space of quality, growth, and getting valuation right. And if we can find the best businesses in the world that are also growing profitably, not just growing for the sake of growth, and get our entry and exits right, then we stand to do substantially better than the market. This is why we believe that our long-term, quality-focused, growth-oriented investment strategy with a strong valuation underpin is differentiated from most other quality managers and is likely to lead to the compounding of your real wealth over time. Next slide, please. Back to what is real. We're all familiar with the investment guru and sage, Howard Marks. In 2001, he titled now one of his famous investment memos, "You can't predict the future, you can prepare." And so too it is with investment. In the face of uncertainty, and we've all been through a number of market smash-ups, what can we do? We can prepare by owning the best businesses in the world that are consistently profitable, earning high returns on invested capital, and growing through all business cycles. This is how we prepare and position ourselves to compound investor wealth. Next slide, please. Managing expectations is key. What do markets deliver over time? It's a mathematical maxim that given a reasonable starting valuation, the best a company can do for investors is to deliver an investment return that approaches the return on invested capital of the underlying business. And so too it is with the market in aggregate. Most of you will be familiar with this picture. The red line is the cost of capital of the median company in the aggregate. As you can see on the right, the WACC of this company is about 10%. The green line is the return on invested capital over time. This line rises and falls, but never strays too far. The gray bars represent the spread between the green and red line, or the EVA, the economic value add. Over time, this cumulative progression of gray bars is represented by the purple band. In sum, ladies and gentlemen, the median company in the world has earned on a cumulative basis only 1.4% per year over the cost of its capital since 1995. Those are meager pickings. Ladies and gentlemen, if you are a long-term passive investor, the best you can hope for is about 8 to 10% in US dollar before fees. That is what's real. If you want more than that, you need to do something else. You need to fundamentally lift your ability to earn a higher return. Growing quality companies that earn high returns on invested capital bought at attractive prices get you there. Next slide, please, Dan. Let's dip into some homegrown example. Here's an old friend, Nedbank. Over 20 years, on a nominal basis, this has been up and to the right. But was it a real compounder? Did you seriously grow your money? No. Your wealth compounded by 5.5% per year, up 3 times over 20 years. Today, you can put your money on a 60-month fixed deposit at Nedbank and earn 8.25% per year. That's better than investing in the stock with less risk. I think we can all agree that we're dribbling along here. You're not compounding wealth. Next slide, please. Staying amongst friends, Capitec, same 20-year period. Your money compounded at 30%, growing real wealth seriously. That is almost 200 times your money. Even if you invested 5 or 10 years ago in Capitec, you would have still done way better than investing in Nedbank. Now, we could argue all kinds of things about the merits of Nedbank and Capitec as companies and as investments, but there are some simple facts that stand and explain why an investor today is likely to do better from Capitec than Nedbank. Next slide, please. Here, let's call this a digital photograph of Nedbank, a CAT scan right into the heart of the business, all made possible because of our advanced data analytics and valuation tools that we use. This chart shows the financial return capability of the bank. The return generated from every rand invested in the bank. That's the green line. The red line, if you want to put it crudely, is basically the cost of running the bank measured against the capital that is at work. It's well above the green line. This business is turning bucket in a water in a bucket. It's struggling to stay afloat. It is destroying shareholder wealth as we speak. Is this real quality? Next slide. Here's the same picture, but this is the picture for Capitec. Worlds apart. The green and red are far apart, generating real wealth for shareholders at high returns on invested capital, growing EVA for shareholders day in and day out. This is the measure of real quality. You can see it in the numbers. For investors, Capitec may feel expensive at times, but there can be no comparison between a business that produces returns on invested capital of 30% with an EVA spread of 12% versus a Nedbank that produces returns on invested capital of 11% and destroys economic value add to the tune of 8% a year. Now, the last 20 years have been volatile in South Africa, yet quality performs through the cycle. You should not be surprised if you get a better return from Capitec and a mediocre one from Nedbank. The one is real quality and the other is not. Dan, next slide, please. Now that we've set the stage, let's scour the globe. Let's go to Brazil, because ultimately we're running a global fund, not a SA fund. Here's a version of Nedbank in Brazil. This is Banco Santander. You've seen them sponsoring Formula One, a giant in the world and a top 5 full-service bank in Brazil. Take a look at the red line and the green line on the top chart. The red line, the cost of capital for Banco Santander, is permanently above the green line. This bank destroys shareholder wealth year in, year out, right in front of your eyes. Now, it might be a great place to bank, but I can assure you that it's not a great investment. Also, look at the turquoise bars. These bars show the incremental return on invested capital earned on a trailing 12-month basis. This bank has its moments when it earns great returns on the additional capital deployed in the business. Investors get excited, even hopeful, but don't be fooled. It's an illusion. It's not a pipe. For the most part, this business destroys shareholder wealth. Next slide, please. Banks are notorious for blowing up shareholders, but the same is not true for every bank. Here's Nubank, a digital upstart in Latin America, founded in 2013, operating in Brazil as a competitor to Santander. This chart is very similar to the chart for Capitec in 2005. Something fundamental has shifted. The company has reached a critical point of intrinsic profitability. Why is Nubank different from every other bank yet so similar to Capitec? For starters, it's digital, it's online only, app-based. There are no legacy costs, no system issues, no branches. Its transactional lending and credit products are simple, transparent, and cost-effective. People understand the products and want them. Think of what Capitec did. It was revolutionary in the early 2000s. Effective, accessible, cost-minded, put a branch where customers were, taxi ranks, shopping centers. Stayed open. Your customers also have to go to work like the rest of us. Be convenient. Keep it simple, transparent on fees. And very simply, don't rip off the customer. And so Capitec grew and grew and grew. Changed banking for good in South Africa. When you give people what they want, you grow as a business. So too with Nubank. Growth has been phenomenal. 100 million customers in Brazil, with Mexico and Colombia nascent for them. More than 20 million people in Brazil today have a credit card because of Nubank. Traditional banks weren't prepared or just didn't know how to lend to this cohort, and the opportunity remains large. Less than 1 in 2 adults in Latin America have a bank account. And Nubank will continue to grow. Why? It's a cost leader. In Latin America, traditional banks spend between $50 and $100 to acquire a new customer. Call it $75. Nubank spends $7. Nubank gets 10 customers for every traditional bank customer without any friction. Also, on an ongoing basis, a customer costs Nubank less than 80 US cents per month to service. That's about 14 Rand a month. That's less than a tin of Coke. The traditional bank spends 10 times that per month. Think about this in terms of your own bank fees. So how can you not win if your costs are 1/10 of the competition? Now think about all the opportunities that this advantage unlocks for Nubank in the years to come. But let's get back to the chart. Nubank has fundamentally changed gears. Ladies and gentlemen, this is the important part. Nubank has stepped onto the path of highly profitable growth. There is no doubt in my mind that a long runway of profitable growth lies ahead. Multi-bagger shareholder returns beckon. Next slide, please. Let's get back to what we want to do here at Mazi for you. If you attend the conference in May in Pretoria, you'll remember our all-time compounder table, the best of the best. In the block is Capitec, up 4,400 times in US dollars, number 19 in the world of all-time compounders. And there's some other exceptional businesses that have also done the job and created wealth and continue to deliver for their shareholders. Walmart, Microsoft, Applied Materials, Nvidia, Altria, Amazon, to name a few. They're true wealth generators, but they were yesterday's winners. Our quality investment philosophy and repeatable process enables us to find tomorrow's winners for you today. Next slide, please. Winning at all costs is not the whole story. Managing risk also matters. What better way to preserve and compound your wealth than by owning a portfolio of high-quality global businesses? But consider the results of our process, a really diversified portfolio. Take a look at the top 10 in the benchmark, replete with Mag 7 stocks. This is in gray in the table on the left. Yet, consider our benchmark beating top 10 on the right, only one Mag 7 stock. The rest, a diversity of sectors and industries. We deliver wealth compounding performance, ladies and gentlemen, with diversification for our investors. That's real risk management. Next slide, please, Dan. Ultimately, performance is what matters, and that's why we are here. A great story is just a story if it doesn't produce the numbers. Over all periods, we have delivered top quartile performance relative to our CISA global equity peer group. This is the direct result of our repeatable quality investment process. If you need a reason to invest with Mazi, it's right here. Next slide, please. Let's wrap things up. Today, we manage about 3 billion in global equity, and who knows where we will be tomorrow. We are significantly invested in our own fund. Yet, compounding wealth requires you to be mindful of costs and fees. Fees don't determine performance, but they certainly reduce performance, and that's why costs matter. And that is also why we offer you the opportunity to compound your wealth in a seriously attractive institutional fee class, where Mazi charges only 65 basis points investment management fee. Eugene, thank you very much.
Andreas, thank you. To the point as always. Thank you very much for that. You should have started with the last two slides because, like you said, a story is only a story if there's no numbers, but your numbers are clearly there. And I can add to that, I mean, your total investment charge is coming in below 1%, which is unusual for a lot of these global equity funds. Just a very quick question, and just to try to understand some of your thinking. Normally, if we deal with quality managers or global quality funds, one of the names that always pops in there, or most of the time always pops in there, is NVIDIA. One of the holdings you have not got. Your thoughts quickly on NVIDIA. Why is it not a share that you hold?
It's an excellent question. NVIDIA has phenomenal results. If you look at it in terms of that company DNA or that photo, right, CAT scan right into the heart of the business, it's also got a broad a purple band, and it's got an enormous future to participate in. It's certainly very attractive. But for one, we don't have to buy every single best stock in the world. That's the first thing. The second thing, which is more pertinent in our lives, is that it's very hard for us to appraise the range of outcomes, despite their technological leadership in the years to come, in terms of, you know, what do those profits look like? What do those margins look like? There's a huge amount of competition coming at them from all directions, whether it is just within America, cloud titans building their own chips, whether it is established players doing the work, or whether it's China on its own AI sovereignty mission. So fundamentally, I think down the line, the margin structure looks very different, and we want to know that the business that we own, the growth is accelerating, but the margin structure remains intact, if not widens, because that then, and the returns on invested capital improve with the passage of time, which is what creates all that surplus profit for us as shareholders.
All about the return on invested capital. So it's not necessarily that it's a bad business, but you find better opportunities. And like I said, you know, it shows in your numbers. Andreas, that's all we have time for. We're going to move on. Thank you so much for joining us this morning. Always great to have you on these sessions, and we'll stay in touch. And the audience, you know how it works. If you want to get to know more about the fund and Mazi, give us a call and we'll get you in touch with Andreas as well. Thank you so much. Right, proceeding on, and we're going to look at global property. Also a man that needs very little introduction. You've seen him so many times on all our sessions, on our road shows, on webinars, and we've had special sessions as well. Greg Rawlins, founder and Chief Investment Officer at Ridgeway Global. Good morning, Greg. How are you doing?
Good morning, Eugene. So great to be on screen again, and thanks so much to the BCI team for this invitation to present to this great audience.
Greg, to put you on the spot just before you start, I mean, we've spoken so much about global property over the past almost 3 years. It's a good diversifier, and how it can potentially benefit clients in a rate-cutting cycle. 2024, we had a couple of highlights on global property. It did contribute to add value to client portfolios, but the past 12 months, markets just seem to give everything up on global property. So I think we all want to know, going forward, what can we expect? And is global property indeed more insulated from tariff risks? But I'll leave that over to you, Greg. Thank you so much for joining, and the floor is yours.
Thanks, Eugene. Your questions are very pertinent. I don't know if you've looked at my presentation, but I certainly will be addressing your questions in the presentation. So I want to start off with highlighting some 2024 regional performances, a selection. And the first one is North America, which delivered a 16% total return, albeit from a very low base, which was driven by healthcare, or the quaint description now is the silver tsunami, as it's riding on the back of increasing an aging cohort in the population. Data centers have performed well in 2024 and continued to do so have continued to do so in 25 this year, and also retail and triple net leasing. I must just point out, triple net leasing, most of that property is retail in any case. So all these in North America, these performers being healthcare, data centers, and retail, which make up approximately 40% of the market capitalization, have continued to perform through to 2025. However, in Europe and the UK, there was growth in the US residential market and the UK student housing market. However, the German residential market, there's two overhangs there, and that is many of the cities have threatened and have already imposed rent controls. So that is suppressing growth. And yet, every now and again, depending on what the voters decide, a new regime comes in and they change it, and there's usually a positive or a negative reaction. But that is not appropriate for a long-term value investor. So we have stayed away from German residential in 2025. And another overhang is that word out in the market is that many of the 2 million Syrian refugees who came into Germany could be going back home, reducing demand for residential accommodation. Further, in Europe, office was weak and continues to be weak. Retail was weak for most of 2024. However, things are looking better for European retail, and we've recently increased our exposure to that sector. Finally, another highlight I just want to bring to your attention, there's many other regions, that Canada was undervalued versus US peers, despite strong potential in seniors housing and industrial. And coming into 2025, we still see it as undervalued and waiting for a value unlock, that is. And we believe that it is the overhang of the tariffs that still have to be finalized before we see a real growth and revaluation of Canadian REITs. So we have an exposure, but we're sitting on the sidelines and possibly could increase in time to come. So before we get into the outlook, it would be naive and not to take into account the risks. And still to this day, the debt refinancing wave, particularly in the commercial property sector. In commercial property, what we know in South Africa is what is privately owned. There is still this overhang. The media seems to have forgotten about it. but there's a large volume of maturing debt during this year and next year, which may push borrowing costs higher. But the most important problem is that there's a structural weakness in the office sector, where most of the debtors' exposure is to the US regional banks. The problem with global office demand remains weak amid remote back-to-work trends, and we have avoided office REITs in our portfolios. So this is a major threat still. It's not just a threat to property, but it could also be a threat to the overall market. We've already seen 2 regional banks go down in early 2024 on the back of their overexposure to the commercial property sector. And the other risk is if the long-term yield exceeds 5%, that of course is a 10-year US 10-year bond. That could pressure valuations, and notwithstanding that, it'll probably roll into virtually every other sector in the market. I also want to say there is also another sensitive point, and that is when the 10-year exceeds 4.5%, and here the market overreacts to it. It's pronounced across the board, and of course the property sector. However, it's staying in a band below the around about 4.3%. Of course, we're all looking forward to the September the 17th when the Fed makes its decisions. So those are the threats to the property sector in particular, notwithstanding that they probably could roll into the broader market. And I assume that you understand that the US 10-year in particular, the yield is an embodiment of risk-adjusted returns. So the outlook. So despite those risks that I've highlighted, global REITs are continue to recover this year as fundamentals continue to stabilize. Eugene did highlight that it's been all given back. Of course, I'm talking about a relative recovery, which I'll highlight. And the fundamentals, the main fundamentals that are driving this is that real earnings growth is in the region of 5%. That is on the back of low supply and strong demand in most sectors. If I can go back to the low supply, there's literally no construction of consequence across the globe, that is, let alone in the US. Of new property coming onto the market. Of course, that doesn't apply to data centers, which just where there's insatiable demand driven by various drivers like AI and the cloud. Further, at the moment, the market is betting that the Fed will reduce rates. No longer are they talking about 50 bips, but there still is a good probability of a drop in interest rates by 25 bips on the 17th. And this will be a very good catalyst for property going forward. Finally, the outlook of real estate, particularly in the US again, which makes up 75% of the global market capitalization. Real estate has remained relatively insulated from tariff risk. And a classic example in our second tariff tantrum, towers only declined by 3%, but the retail sector declined by 19%. This notwithstanding, there was a fantastic recovery a few days later after the second tariff tantrum in April. So the top sectors and themes, as I mentioned, going through, and we are overweight healthcare and life care as the demographics continue to drive demand for senior housing and medical facilities. Data centers and digital infrastructure, insatiable demand, no sign of overbuilding. And this is driven by AI, the cloud. Everybody's talking about AI, but the cloud and 5G are all fueling growth and demand for data center facilities. And the retail and triple net lease continues to make a recovery, albeit again from a low base, as select malls and strip centers are currently delivering 4 to 6% yields, and any catalyst that will cause the compression in those yields, we'll see a significant rise in retail assets. And these are performing well as a result of limited new stock coming onto the market. Excuse me. The building of new malls and strip centers is very muted. And also department store space has been replaced by higher returns from experiential destinations like bowling alleys, bookstores, sporting goods, and large food courts. I just look at the Canal Walk Shopping Centre, which is a few hundred meters away from our office. There is I can just have a glass of water. Excuse me. There is more brand shops. There's an Adidas and ASICS shop. There's a Levi's and Pringle shops. And the mall operators are able to extract higher rentals from the traditional department stores. Some key statistics we've now received all the second quarter results of the US, and I mentioned the US, again, the largest component of the market capitalization, and 62% of US REITs have raised their one-year guidance. So besides top-line growth, the upside revisions were surprisingly driven by lower expense expectations as well. This in the main being insurance, property tax, and marginally lower labor costs in the residential, hotel, and skilled nursing sectors. I must observe this is not going to happen in South Africa. There's no indication of this happening here, but it's happening enough in US, and enough for them, for the REIT managers to increase their guidance going for the next 12 months. So we're talking about the recovery, and I mentioned a relative recovery. This is the global property index in US dollars versus the S&P since the beginning of January. And as you can see, it's literally a neck and neck performance between the two indexes. And this recovery is effectively, in my view, started in the second half of last year. It was a little bit spotty, but it's reasonably safe for me to put forward that this recovery trend is now at least a year old. This is a recovery relative to the S&P, albeit also from a very low base. So what I would like to do here, and what we have done here, is compare the iShares US Real Estate ETF with that of the S&P from the 1st of January 2000. And as you can see, the US REITs outperformed the S&P 500 by a significant larger margin up to 2007. There's been a steady decline of this relative performance, but still was credible and warranted an allocation. However, from the beginning of 2022 up until halfway through 2024, it was a forgettable period. The market has, to a large degree, ignored it. That's what I suggested, and that is a reallocation. But there has definitely been a rotation back into global property, and as I pointed out, that this is now starting to show of the performance relative to the S&P for the last, in particular, for the last 8 months to August. So it reflects effectively the pain that real estate investors have endured over the 3 years to December 24. Yet the parallels with the 2000 and 2002 market are striking. The dot-com era was characterized by ultra-high growth in emerging tech, concentrated leadership, and momentum driving gains which masked underlying economic weakness. The fundamentals were stretched with scarce earnings, historically high multiples, and I think when I'm getting a message to say my power is starting to run out. Please bear with me for a second. There we are. Okay. Sorry about that interruption. But just summarizing, in 2022, fundamentals were stretched with scarce earnings, historically high multiples, and excess leverage, and a Fed perceived to be late to the cut. Today, AR valuations are extended, leverage is less of a concern, but inflation lingers, and the Fed again risks being late. Have to recite a little poem. History doesn't repeat itself, but it often rhymes. So why buy REITs with earnings growing at 5% when tech companies are growing earnings at 13% plus, in some cases 13% plus plus? Well, overweighting a sector at a 25-year low with double-digit total return potential into a rate cut cycle is worth a consideration. Some would call it prudent, considering the relative safety of REITs. Risks remain. Tariffs are complicating rate cuts. We only saw another, or could this be another tariff tantrum that happened, that started late last week when legislation started to question, or the US legal system is starting to question the White House tariff policy. But history suggests this is a compelling entry point to a long-term investment. So finally, would like to track the REITway BCI Global Property Feeder Fund relative to its benchmark over the last 10 years. And as you can see, we have been delivering a credible performance relative to the index in blue. However, since mid-2023, we have declined. This performance has declined, and we've done some deep introspection, and we completed a cosmetic change to our process. It'll take a few seconds to do, a minute or so to describe, and a few more minutes to explain why. But it's a very, very simple change, and we believe that we will be seeing a significant recovery in our performance relative to our benchmark. Finally, before I hand over to Eugene, Dan, please can you bring up the poll? And I would appreciate if you can participate in this poll, as it'll be valuable to us to find out what you as investors feel about an allocation to global property in your portfolios after considering the recovery that we are seeing that has gone back for 12 months. And thank you. Eugene?
Greg, very interesting to see that poll results coming in at the moment. Already invested roughly about 28%, planning to rotate roughly about 8%, monitoring for further signals, big number there, 43%. And I mean, the one slide that you showed there's a compelling argument that's a good entry point into property at this point in time. But let's see, time will tell. Greg, maybe just one question from my side. If we do consider to rotate and watching those signals, and we agree to add a bit more property or global property to client portfolios, why REITway?
We have been, we are very conscious on performance. We are very conscious on a team effort. And we are also now conscious of a new phenomenon of the impact of momentum on the property sector in particular. So value, you can be a value investor, but the value may be suppressed for years before it's realized. And you've got to be conscious of momentum in your allocations and your positions in the REIT market, which may be contrary to what a lot of other portfolio managers do. We are value investors who are cognizant of the impacts of momentum.
Very good point that, Greg. And again, thank you so much for your time this morning. Always valuable to have you on these sessions as a property or global property expert. Thank you so much for your time, and we'll stay in touch.
Thank you. Goodbye to the viewers.
Right, we're continuing on global equity, and our next company joining us is Guinness Global Investors, a company that's been long-standing and numerous accolades and awards for the top global fund management company. Some of you were introduced to the business when we had our February road shows, where you've met Flurry Wright, who said she's always right. This morning we are joined by Dr. Ian Mortimer from Guinness Global Investors based in London. Good morning, Ian. How are you doing?
I'm great, thanks. How's everyone?
Very good, thank you. Ian, thank you so much for coming through or joining us this morning. Always insightful to see what you guys do, because you've got a very different approach in when you look at stock selection and what you offer in your fund. To our audience as well, I mean, if you, some of you that's been around for a very long time, the company has its roots way back when Guinness Flight Global Asset Management was still in existence, and it's part of history of this firm. So very interesting indeed. And Ian, you focus on quality dividend-paying companies, and very keen to see again why you think that these companies will continue or believe that it will outperform. Thank you so much.
Thanks so much, Eugene. Great. Yeah, so thanks for the introduction. So yeah, so we're going to talk about dividend-paying companies, quality companies as well. So what I propose to do is give a quick intro to what we do, a reminder of why we think this style is interesting, and then I'm going to talk a little bit about what we're seeing in kind of global equity markets from more of a macro perspective, and then very happy to take questions at the end. I'll let you read our risk and performance disclaimers at your leisure. And as Eugene mentioned, we're Guinness Global Investors. We were founded in 2003. We've got a long history looking at long-only equities. Today we're over $11 billion in group assets, and we remain 100% employee-owned. But really, when we're thinking about global equities in terms of the team that I head up with my colleague Matthew Page, it's really coming from one philosophy, first of all. So it's all about companies that can maintain a high return on capital as they grow, should outperform. So it's all about the idea of good companies compounding up their success and doing that over long periods. We actually run two strategies, so it's kind of two flavors, if you like. One is global equity income. So this is focusing slightly more value orientated companies that pay dividends, more defensive in nature. And we also run the Guinness Global Innovators portfolio, which is more sort of focused on growth. So again, the idea of compounding, but slightly higher growth. And what's interesting for us is we can therefore look at sort of both sides of the coin. So we've got a view on what's happening on the more value side, and we're also very interested in what's happening more on the growth side. And clearly there can be some overlap in terms of the portfolios, where you can find really good companies that are both growing and also paying a dividend. We've got a long track record of both strategies. The Global Equity Income Fund since 2010. So it's a product I designed with my colleague, Matthew Page, and launched sort of post-financial crisis, thinking about resilient businesses, companies that should do well in lots of different economic environments. And then our Global Innovator strategy goes all the way back to 2003. So kind of investing in global equities for over 20 years. And today we run over $10 billion across those two strategies. But let's move on and think a bit more broadly about why one might think about investing in dividend-paying companies. And really, the idea is very simple. Dividend-paying companies can outperform over the longer term. Lots of good evidence that these types of companies are well managed, that they're thinking about capital allocation effectively, because they're not just spending sort of to grow, they're actually thinking about returning cash to shareholders and reinvesting it back into profitable projects. But a key differentiator, and something you have to be very careful of, is if you stretch for high dividend yields, you massively increase the chance of a dividend cut. And so often when people think about kind of income, they think about high yield type products, and whether that's more on the fixed income side or on the equity side. And what we're actually saying is, don't stretch for high yields, look for moderate, kind of good above market yields, but look for those dividends that can grow, because what that means is the companies grow, the dividends grow, and that in combination is much more powerful. Because as we know, if you see a company that cuts their dividend, you tend to have quite poor performance from a total return perspective. And crucially, if you're looking at the performance period, T0 is when the company actually cuts its dividend. You tend to see the underperformance leading up to that. So it's not about waiting for the cut and then moving on. It's about trying to preempt any companies that are going to cut and make sure you avoid them in the first place. To do that, we think the best place to start is quality. We think about quality through the lens of return on capital, balance sheet strength, and ultimately that kind of sustainable competitive advantages. Global businesses, recurring revenues, pricing power is what we're looking for. We also want to see growth. So we want to see profitable growth. So we don't want these companies just to be stagnant and paying out a dividend. We want themselves to be growing, because that way that drives also earnings growth through our companies, not just the dividend. And ideally, if you can find them at a reasonable valuation, then you have the opportunity for a re-rating as well. So that means you should get all three parts of the total return: earnings growth, multiple expansion, and shareholder returns. And we do that in a very concentrated way. So it's a 35 stock portfolio, and we run that approximately equally weighted. So our position sizing is around 3%. We're using active rebalancing to try and take advantage of any short-term market volatility versus our long-term view. And we're also keeping it very tight. So it's a one in, one out process. We're constantly thinking about new ideas, but in the comparison to what we already own. So do we have the best stocks within our portfolio? And if you think about the type of sort of return profile that this can achieve, it's interesting to think about how that comes about as actually, we think, potentially better performance, but also maybe lower volatility. And that is very attractive, I think, to lots of clients. So this is just a chart showing you the S&P 500, different types of dividend-paying companies within that cohort. And it's really showing you that if you actually grow your dividend over time, you tend to outperform the benchmark. You do better than the companies that don't pay a dividend, and you clearly do much better than companies that cut their dividend. So avoid the cutters, look for the dividend growers. And what's interesting is if you then look at the volatility, so the standard deviation of returns, you find that actually the highest volatility is in the companies which cut their dividends, which have the lowest returns. Whereas actually the lowest volatility tends to come from those that grow their dividend. So again, you're sort of improving your chances of that kind of risk-adjusted returns, if you like. And that's actually a very, again, as I say, I think an attractive quality. What's the best way to find companies that are most likely to pay and grow their dividend? It isn't how long the company's paid a dividend. We tend to find that doesn't correlate very strongly. It doesn't tell you a lot about what the company will do in the future. Payout ratios, again, not that helpful. Payout ratios can shift very quickly when earnings change in sort of more distressed markets. And what we find is actually return on capital and balance sheet strength are the two main indicators that can tell you a lot about what a company will do in the future in terms of that dividend. And this is just a chart showing you the number of years that companies have actually upgraded their dividend in the last 10 years. So if you're in the 10 cohort, every single year, you've increased your dividend for the last decade. If you look across then to the y-axis, you can see what's the average return on capital. And there's actually a pretty strong correlation between the two. So generally what we find is if you've got that high and consistent return on capital, you tend to have a much greater chance of paying your dividend. And again, what's very interesting about that is if you then look at the kind of the volatility profile, if you like, of that return on capital, again, the more consistent companies tend to be the ones that have done it more consistently. So kind of good companies tend to stay good. And obviously that then leads to better companies paying their dividend as well. So all of that we find really comes together very, very well to get both growing companies and companies that can pay that dividend alongside. And ultimately what we're then doing really is bottom-up stock selection. So we're then thinking about, yes, there's lots of companies that we think are very good. So in terms of their return on capital, that can be very consistent, that they've avoided the fade that you often see in many other companies. But what's interesting about that is it's very persistent. So we find if you have that a very long track record, so we're looking back over a decade, you find there's a 93% chance you'll continue to be in that high quality group the following year, and there's over 80% chance you're still there 3 years later. So again, that idea of persistency is very key to our thinking. The other thing to remember as well, though, is one might imagine that all these good companies are priced like that. One can see it. We know it's persistent, therefore they should be valued appropriately. But as we know, markets move over short-term sentiment and other things. So we find actually you can find pretty good value opportunities in some of these high-quality companies. So because we have a global remit, we're looking across geographies, different sectors, different types of businesses, different industries. We find there's often and very consistently companies that have these high quality characteristics that may be overlooked for some reason. So here you can just see the overall portfolio. We try and be quite transparent, all the 35 companies we own. You can see the market cap, you can see the percentage of NAV, shows approximately equally weighted portfolio. And then for reference, you can just see the market expectations for forward PE multiples, just to give an idea of valuation. And when we look down to the bottom, you can see the total portfolio here actually trading at a discount versus the MSCI World. So what we think we've got is a high quality group of companies that are actually trading at better valuations overall than the benchmark. And within that, we also want to note that we've got a good balance between both defensive and cyclical companies. So often, again, people think dividends, they immediately think kind of blue chip type companies, consumer staples and so forth. Whereas yes, we do own consumer staples and healthcare. Defensive areas take up about 45–50% of our portfolio, but we also found really high quality companies in more cyclical areas, things like industrials, IT, financials. And so often, we're trying to find that balance, if you like, from both companies that are kind of leveraged, if you like, to more of the economic cycle, those that are more defensive, but overall, all of them being quality. So even within our industrials, for example, there are companies that have lots of recurring revenue, good service businesses, more contractual, so therefore they are less cyclical, although they remain somewhat cyclical. And therefore, we still think, and we have seen, these companies perform very well, even if markets may be more volatile or distressed. And this is a chart that we like to show in terms of how the portfolio has performed in those different those periods of market distress. So this is the MSCI World, just in US dollars. And then you've got all the different periods where we saw some kind of market sell-off. Probably easier to read on this chart. And you can see it goes all the way back to 2011. So the European debt crisis, taper tantrums with Ben Bernanke, tech sell-offs, coronavirus, all the way up to what we've seen more recently, the Trump tariff uncertainty. You could then see the MSCI World return in US dollars here. You can see the Guinness Global Equity Income Fund return next to that, and then the fund relative performance. So you can see that actually in every single one of the sort of more significant sell-offs we've seen in global equity markets over the last sort of 14, 15 years, we've actually outperformed in every one of them. And it's interesting to see, for example, what was happening in this year, which has been a very volatile period for markets. we actually, when the markets fell 16.6% from mid-February all the way down to the Liberation Day tariff period, the fund actually outperformed by 7%. And what you can then see, just some other sort of risk and return analysis, is kind of where the fund sits versus the benchmark, and then other peers within our group. So we've generally had strong returns, sort of keeping up really well, I think, with markets that have been dominated mostly by growth over the last periods, but actually done that with a lower volatility. And we think that's something that, again, we see as quite attractive in terms of an allocation for many types of clients. Good access and exposure to the equity market, maybe with a lower kind of risk type profile, one that would generally be more defensive if markets are falling. But we might not keep up quite so much in a sort of very strong equity market rally. But we should do reasonably well. And I think if you add that up over the long term, I think that's quite an interesting way to get exposure to global equities, particularly at the moment when we're seeing lots of different risks, as ever, frankly, across markets. So what I might do now is just spend a little bit of time just flicking through some of the things we're thinking about, what we're observing. We don't tend to run our portfolio based on our macro view, so it's more bottom-up driven. But clearly we need to be aware of what's happening around the globe, what's driving markets, and then also thinking about any individual stock exposures that we have to that that might be impacted. So clearly the big event, if you like, that's been happening through markets is this tariff uncertainty. And you can see how that massively ramped up through the start of April. That's what spooked markets. That's why we sort of saw this big market sell-off. We then had that 90-day pause, which effectively fired the starting gun, if you like, on the very strong recovery rally that we've seen. It's generally been more driven by kind of US growth and European value in the form of sort of European banks and defense companies typically. And although a lot of this has been resolved to an extent, I think there remains quite a lot of uncertainty. We've seen it going through the courts recently. We've seen some countries that have done deals, inverted commas, things like Europe and the US and the kind of major points of trade, but places like China are still to be resolved. And also the actual impact of tariff is really something that I think is still quite uncertain, because we haven't seen certainty on what the tariffs are. It's therefore, are companies really yet reacting to what the new reality looks like, or are they pulling back and waiting? So when we're thinking about what that looks like from a kind of growth perspective, so just sort of GDP forecasts, so this is going from the beginning of the year up to kind of mid-year. You can see in the US, the dark colored lines are kind of where we were at the beginning of the year and where we've got to more recently. You can see there has been a sort of lowering of growth expectations in the States over that period, whereas in China, the Eurozone, not necessarily as affected, UK probably for more specific reasons, we have seen that. So we have seen a general sort of decrease in what's going on from a GDP perspective. And clearly we saw that in the first quarter numbers that came out in the States. So kind of a significant drop from where we were in Q1 2025. But what's important to recognize is those numbers were quite skewed. So what we were seeing in terms of that GDP numbers coming out of the States being lower, that was really on an acceleration of imports that occurred before the tariffs hit. So the way you're kind of working out what GDP has completely changed. So therefore, it's difficult to really get a clear view from that data point about what's happening. Similarly, if you're looking at things like consumer sentiment index, we saw that fall through the period. It's now somewhat recovered, but we're in a bit of a limbo. We're still not quite sure, what the consumer's doing, what they're thinking. And again, because we're not yet getting very clear data points. Similarly for inflation, so this is just the headline CPI numbers. We've seen that beginning to tick up. If you're just focusing on the US at 2.4%, that is above the Fed target. So Fed typically looks at PCE, but as a kind of proxy. And we saw that more recently just tick up. So we're not seeing huge impact of tariffs on inflation numbers yet, but we are seeing inflation tick up. And again, that's quite a big question mark about how that will all play out. Similarly, if you look at though what's driving those CPI numbers, you can see it's really the service inflation remains very high at 3.3%, but we are seeing a little bit of a tick up in some of those other areas. If we're then looking at kind of rates, that's clearly a big element of what the market is looking at. So it's interesting here, we just highlighted the US. So we have not seen any rate cuts from the US for a significant period. Clearly, that's again massive headlines in terms of what's going to be happening in September, expectation for rate cuts and so forth. But they've got a striking a balance. So they're now looking at inflation potentially increasing. Still haven't seen the impact of tariffs, but maybe a little bit more worried about the jobs market, and therefore their dual mandate is shifted. But the US obviously looks quite different to a lot of countries that we're seeing around the world in terms of rate cuts. Similarly, but where the market is pricing is lots of rate cuts. So this has been shifting around quite a lot, but we're seeing expectations for at least 2 to 3 rate cuts coming into the end of 2025. But interestingly, if we shift over and look at what is expected for 2026, that's a continuation. So again, what markets are currently pricing is rate cuts starting and continuing for quite a long time through next year. That pace has increased, by the way. So kind of expectations for rate cuts has definitely been moving upwards. But what we know is when we're shifting and looking at the jobs numbers, they've weakened. So again, there's 2 dynamics playing out, inflation and jobs. But the market seemingly has looked past all of this and said, we do really expect rate cuts to keep coming through. So that's clearly a risk in markets. When we saw the weaker jobs numbers a couple of weeks ago, markets fell 3% in a couple of days because all of a sudden, the question marks came up. What if we don't get the rate cuts? What's that going to mean? And I think the US dollar weakness is playing into that as well. Again, general trend this year has been dollar weakness. Just recently, we've started to see that increase. Why is that increased? Because we're seeing the long rates in terms of long bonds shifting. And then finally, I guess we're sort of thinking about how companies are reacting, which is going to be more important. We're definitely seeing more conversations around what that means for companies and whether they're thinking about that leading more to a sort of recessionary nature. So to conclude, we're definitely seeing the Trump tariffs impacting trade and consumer sentiment, but interestingly, not at levels that have been potentially expected. So kind of the worst case scenario seems to have gone away and the market's taken that very positively. But we are starting to see an impact on inflation. And that's against the idea that actually expectations are high for rate cuts in 25 and 26. So again, how does that play out? But we also might see upcoming tax cuts, which generally net positive for equities if enacted. So our view is really, obviously, we're trying to digest this like everyone else is, but we're sort of broadly positive over the long term. But clearly risks to the downside remain. And we hope our approach should hopefully protect more if those risks come about. And if they don't, we should still get a reasonable capture of any of that upside. Apologies, I think I've just overran, but thank you very much for your time.
Ian, great message and very interesting to see how you manage the Guinness Equity Income Fund. For the audience, we run a feeder fund in SA, the BCI Guinness Global Equity Income Feeder Fund. The feeder fund's fairly new, but the underlying fund has been running for a very long time. I mean, Ian showed you the numbers as well. Ian, sorry, just a quick question. With regards to the holdings in your portfolios, and with all this uncertainty going around, have you seen a significant shift regionally in terms of where you find these quality companies with high dividend payoffs? Has there been any major changes or new companies popping up on the radar over the past 6 or 12 months?
At the margin, I'd say yes. I think clearly the sort of the big headlines are valuations in Europe more broadly are somewhat better than they are in the US. And similarly, you could make that case for sort of Asia and emerging markets. I think we've been a little bit more positive on some companies with more exposure to China, actually, and seeing better valuations. So again, we're pretty low turnover, so we're not making massive swings. But the latest edition, we actually did make one change to the portfolio last month. We'll be publishing that probably next week in our monthly update. I'm not allowed to say what it is at the moment. And that company is actually more exposed to domestic China. And I think that's an interesting scenario that we've seen, where maybe the kind of the regulatory regime that was very, very negative sort of 3 years ago from a kind of government perspective in China has actually started to soften, we think. And therefore valuations look very compressed there, and we think that could be quite interesting. Overall, though, the portfolio remains about 20% underweight the US. So we're about 53% in the portfolio versus sort of 75% in the benchmark. And we're actually overweight commensurately in Europe, and we're about equal weight in sort of Asia emerging markets. And I think that's we think quite a good balance in terms of that exposure.
I think those comments are very valuable, because I know there's a lot of investors trying to see if they can find alternative opportunities, and that scatter chart of yours really illustrated it well, so it can keep up if markets are still going. But even if some of those risks do come to bear, more defensive stocks can actually help your clients' portfolios extremely well. Ian, thank you so much for your time this morning. We're really, really grateful. And we'll continue to host you on these sessions and with upcoming events. Thank you so much.
Pleasure. Thanks, everyone. Have a great day.
Thank you. Right, we're continuing for our last session just before we have a quick comfort break. We're going to look at emerging markets. And last week, you've had some convincing arguments as to why to include emerging markets in client portfolios, offering attractive valuations relative to developed markets. And we maybe should be paying more attention to places like China. And also made some comments now on China, and interesting to see how they're finding new opportunities, and some of that that is based in China indeed. So is the tide turning or not? Great to welcome Lars Achenbach from Riskera, based in London, to take us or to have a discussion on China and emerging markets and how they see the world. Good morning, Lars. How are you doing?
Yeah, great, Eugene. Thanks again for having me on one of these sessions. And I'm grateful to Ian, who was just speaking there. I can't think of a better introduction to, what's happening and the attractiveness of the Chinese asset management and investment landscape as an independent person putting their oar in there for me. So thank you very much for that, Ian. So what I thought I would do today is actually just do a little bit of a deep dive into the kind of innovation space and technology space in the Chinese market, rather than just give you a macro update. It's really just like an area of sort of special interest, I guess, to several of your listeners, perhaps. So now what I need to look at is why. There we go. Okay, so a couple of words about Riskera. You guys know about us already. We've been on your platform for some time. Emerging market specialists with quite a bit of money and talent deployed in China. I do hope all of our listeners today invested in China on the back of some of our webinars, because certainly the China market is up something like 50% over the last 12 months, whereas the MSCI ACWI is only about 13 or 14% up. So it's been one of the strongest performers over the last year. If you haven't participated, it's not too late. We do have a fund on the BCI platform. I suggest you invest straight away. Anyway, so looking at the kind of innovation and technology space in a little more detail. Back in the day, we used to think of China very much as an e-commerce provider. So things like Alibaba, Tencent as well, obviously well known in the South African market, selling product to domestic consumers, and then also making consumer electronics. So if you bought an iPhone or a Google Pixel, the chances are that it was assembled or manufactured in China. But actually what's happened, while perhaps no one has really been paying too much attention, is that the Chinese economy has diversified into all manner of advanced technology subjects, from robotics to wind farms to solar panels, biopharma, artificial intelligence. We'll speak about that a bit more detail later on. New energy forms, speak about that as well. So the opportunity set has vastly expanded from just a simple, we are the factory of the world, or we have a couple of great e-commerce platforms, to a very well diversified set of insights. And if we look at sort of the progression over the last 10 years, on a number of rubrics here, I've just picked a couple across the top. The Chinese dominance or competence in making drones, making solar panels, making mobile phones, electric vehicles, etc. 10 years ago, the Chinese were clearly leaders then already in the manufacture of solar panels and drones, and were either okay but a little bit behind in most of the other areas. Today they're sort of leaders in half of those, and if we fast forward another 5 years, the predictions are quite strong that actually, with the exception perhaps of commercial aircraft where there's some sort of licensing issues and acceptability issues, and maybe on the robots front as well, but really and everywhere else, the Chinese are predicted to be the global leaders, right? So the trend is very, very strong towards going from being a participant or being a subcontractor to actually innovating and making stuff yourself. And it's across all subsectors, right? And I apologize, there's a bunch of companies on the right-hand side that I suspect not many people have heard of before, but I think the point is that it's across the entire spectrum of consumption and supply sectors, from consumer areas, healthcare, hard technology, so that includes robotics, batteries, and so forth, deep technology like semiconductors. There are Chinese companies in all of these areas who are, thanks to a combination of circumstances, are becoming world leaders and either developing stuff themselves or are the world leading subcontractor in that space. Let's look at manufacturing as a specific case study here. So this is a graph looking at China's market share, global market share 20 years ago versus today on a number of categories again. So, in the drone space 20 years ago, there wasn't a single Chinese drone made. Now they make 3/4 of the world's drones. Industrial robots, from 5% back then to half of them now. Cell phone production, they were about 1/3 20 years ago. Now it's 2/3. Solar panels, 11%, 88%. So almost across the board, doesn't matter which industry, which sector you look at, the Chinese manufacturing is just so well oiled, is so exceptional that it's very hard for companies in other countries to compete. Companies in other countries might innovate initially, but this actual process of taking a product, of mass producing something, of finding production efficiencies, of finding supply chain efficiencies, the Chinese are absolutely phenomenal at this. And despite Donald Trump's best efforts, I find it difficult to argue that an American company would be able to meet this type of manufacturing efficiency. Yes, they can innovate, no question about that. But the manufacturing efficiency is just something completely off the scale. If any of you have the benefit of going to China, they have dark factories there that are running 24/7. The factory is dark because there's no labor force on the actual shop floor. It's robots. There's a couple of dim lights. There's a couple of operators in a control room. If there's an error, they've got a 3D model that says, oh, hang on a minute, this machine has got some problem. They send a guy in there, he fixes it, comes back. But the rest of the time, the thing is just producing products. It is not down to individual humans actually turning screws or driving trolleys or whatever it might be. It's absolutely phenomenal what the Chinese are capable of in a terms of mass production environment. Now, in order to successfully innovate a new product, you kind of need 4 steps. You need some science to begin with. So, you come up with a new chemical formula, you come up with a new way of making a battery, of converting sunlight into energy, whatever it might be. You then need a certain amount of technology, like basically an application of that, like how do I actually turn this chemical formula into something that can work? Then you have an engineering side, which says, let me take this discovery that I've made and produce it into a component or a vehicle or a box or something that I can use. And then you ultimately turn it into a product. Now, the Chinese are probably still behind on the first 2, on the science part. There's not a huge amount of innovative science coming out of the Chinese economy or labor force just yet. And also on the technology side, they probably are still, competitive, but not a global leader. But they are absolutely the global leaders when it comes to engineering it and creating it into a product. So taking these ideas, taking these discoveries, and turning them into subcomponents that can be used in a finished product. So the example I've used here is basically the evolution of the lithium battery that gets used in an electric vehicle, electric car. So back in the day, I think it was actually in the 1970s there, somebody came up with the idea that we can make a lithium-ion battery. It was probably an American company that came up with that. It was very advanced science at the time. Then it took another 10 years, give or take, for that science to be turned into, like, how do I actually, what materials do I need in order to make this science work? It's all very well to have a formula, but you need to have it productionized somehow. But then fast forward another 20, 30 years, then the Chinese start getting involved, and we start coming up with, like, these are different ways that I can construct the battery, the different shapes that the battery can take. How do I replace the battery? How can I charge the battery? What are all the subcomponents that go into charging the battery? And then finally, now that I've got all these batteries, locally, it's very quick for me and very easy for me as a Chinese car manufacturer to come up and innovate new products, because, well, the battery was made by the guy next door. So I can collaborate with that person, and I can come up with better ways to construct that battery so that it fits better into my car, that the packaging is better, the space inside is better, the ability to recharge it is better, the ability to swap it out when it's end of life is better. All those kind of things I can work very closely with my suppliers because they're based, across the road from me. So very well positioned in the global technology chain. And I accept, there's some work to be done in the early bits on the science and technology side, but once that has been established, the Chinese are very, very good at taking over that process. And there are a couple of case studies here. So Cattle, Comparative Amperex, they're a battery manufacturer. It took them only 7 years to become the world's largest lithium-ion battery producer, right? I mean, it takes most of us, 7 years to figure out whether or not we can, our telecom bills are correct or not. And these guys have become the world's leader in lithium-ion battery production in that space of time. The Tesla factory in Shanghai. So this is a global company, Tesla, you're probably all familiar with, one of the largest electric car manufacturers. Their factory in Shanghai, which they built there, is the largest by output, the most profitable, and it was built in only 10 months. In 10 months, you can barely get planning permission to put a factory up anywhere else in the world. And yet here it is, from zero, from breaking ground, factories in production, largest, most profitable. Li Auto, there was a slide on them a little while ago. They're an electric car manufacturer, very quickly catching up, and in fact have overtaken Tesla in several areas in terms of the volume of electric cars which they sell. A couple of sort of slightly funky examples here, but there's battery and energy storage on the left-hand side. There's some pictures of some humanoid robots in the middle. And what I actually wanted to highlight from here is not so much that there's this new technology which is obviously across the world. Everybody's focused on electric cars. Robots are everybody's game. But what people forget is that in order to make a successful battery or a successful robot, there's an enormous ecosystem of subcomponents that are required to make that work, right? So your humanoid robot, it needs little sensors in the fingers, it needs electric joints, it needs sensors in its battery, it needs eyes or ears, the electronic equivalent, obviously, of those, to find out where it is and what's around it, what's going on. If you're a battery, you need the components that go into it, the materials that go into it, the sodium, the lithium, these materials, but not just the actual stuff you pull out of the ground, but also how do you put the physical battery together? There are meshes in there, and kind of cathodes and anodes in there that need to be produced somehow. And everybody focuses on the headline product, but ignores this enormous quantity and network of suppliers, which are absolutely essential in order to make the thing work. And in most cases, those subcontractors and suppliers, the Chinese dominate because it's mass-produced products again, right? It's not as though you're building these little sensors, and they can be used in robots. They can possibly be used in other applications. So there's a mass production angle to it, and that is where the Chinese dominate. So even if on the headline products, perhaps they are a generation behind or not quite as good as say an American one or a European one, it's all of those headline guys are relying on the Chinese subcontractors to provide them with all the necessary components. And in fact, if we look at AI chips, so NVIDIA is obviously the poster child for artificial intelligence chips. Their graphics processing units are world class. That's well accepted. But if you wanted to put down a computing rack, an actual processing center, data processing center, computing center with using these NVIDIA chips and turning them into some fancy AI, well, you need optical transceivers. Guess who? It's made by the Chinese. You need software that connects the chips to each other, the chips to the memory, the chips to the outside world. It's made by the Chinese. You need electrical transceivers. You need network processors. In all of these subcontracting areas, the Chinese companies are dominant. Even if the final product might be an NVIDIA headline thing, and that's why the NVIDIA is now worth several $1 trillion, and it's well done to Jensen Huang and his crew. They've done an exceptional job. But let's not forget who's actually producing the components that go into all of this. Li Auto, I think I've kind of mentioned already, they've grown phenomenally from a nobody into the biggest selling electric vehicle brand across China. And of course, you've got 1 billion people in China. That's a massive market. You don't really need to be a global leader. You can just be a domestic leader, and that's good enough. Thank you very much. Semiconductors, the big elephant in the room. Like, how on earth can you compete in the technology space if you're being denied access to the sort of key subcomponents, the semiconductor portion of the world? And there also, we have extensive case studies, and I've used Huawei as one of the examples here, where the internal research and development that they've done has allowed them to produce phones, mobile, so phones, computers, to produce watches, to produce headphones, etc., using their own domestically sourced technology without having to rely on the American semiconductor technology. And that all of that is being encouraged and fostered by state and local government incentives. So the Chinese state is well aware of the fact that they are arguably being cut off from this technology. The best way to protect yourself against that is to encourage your domestic suppliers and your domestic innovators to come up with their own equivalents. And even if it's only 80 or 90% as good as the one you could have had, that's good enough. You've got a fantastic product. If it's, if my phone is 80% or 90% as good as an iPhone, that's a brilliant product compared to, let's say, where the iPhone was a few years ago. So you don't necessarily have to be at the very cutting edge of technology. You can be a step behind and actually still have a very useful, very productive product. And because you've figured out how to manufacture it quickly and efficiently and cheaply, the profitability of your operation is actually much greater than it would have been if you'd always gone for the latest technology. A couple of words on artificial intelligence. I'm aware the session is quite short. So it's kind of one of the key areas of competition between, say, the USA and China. So where China excels is in the efficient use of existing technology. So those of you who follow the market closely enough, actually, wait, I'm going to just jump around a little bit, but there was a company called DeepSeek, which was actually, it was funded by a hedge fund. It was a bit of a, on the side, private kind of venture, but they came up with a large language model, an AI model earlier in this year, which was able to learn and to grow at a fraction of the cost of OpenAI, which is, of course, one of the most well-known models out there in the world, with a fraction of the employees, a fraction of the cost, and yet the performance benchmarks are actually quite comparable, right? So they're able, the DeepSeek model is able to do more or less what the AI model can do, the OpenAI model can do, but at an absolute fraction of the cost. At the time, there was a significant drop in the price of OpenAI shares, and also NVIDIA shares, because there was the suspicion that these Chinese guys are basically going to take over. They've got the thing that costs a fraction of the price. Since then, everybody has recovered because the frenzy has continued. But bottom line is, between the US and China, those are really the two places where the infrastructure and the willingness exists to develop and have this kind of comprehensive AI-based economy and AI-based technology going. And where I suppose where the US is probably more efficient is in business to business AI. Let's say Microsoft Copilot makes itself available to a company. They can then use that Copilot to make their processes more efficient or their reporting more efficient, whatever it is. Whereas the Chinese are arguably a little more focused on how to make business to consumer AI more efficient. So if you're interacting with an AI, the Chinese are forecasting what kind of product you might want to buy. They're a bit better in that area. And if we just look at the raw talent behind it all, AI researchers, I mean, the Chinese have got, in fact, actually, I'm just eyeballing these numbers here. It looks like the top 20% of AI researchers, half of them are from China and half of them from the rest of the world. But the number of AI patents, half of them are from China, and then, in fact, actually, that's even worse. Like there's 2/3 are from China and 1/3 are from the rest of the world. It's a phenomenal amount of money and talent that's being spent in the Chinese economy to basically ensure there is a certain amount of self-sufficiency and ultimately global leadership in these areas. And now, obviously, we've spoken about DeepSeek before, but I think there's actually a slide on that. I should have put something in here. But you know, what's also forgotten is the typical Chinese computer software developer, computer science graduate is going to cost less than half of what that same person would cost in the US. And that the Chinese universities are churning out something like 3 million of these STEM graduates every year. That's science, technology, engineering, mathematics graduates every year. There's a massive talent pool. It's inexpensive to hire these guys. Like it's how do you compete against that if you've got a fraction of the number of people and it costs you a lot more money to hire each person when you do? So if we just drill down a little bit into, like, you know, what is it that has enabled the Chinese economy to get to this point of success? There's probably 5 or 6 factors that are important. So we've spoken about the industrial supply chain. Like the Chinese economy is one of the few places in the world where there is a genuine, complete end-to-end supply chain for most industrial products, from raw materials to product, you know, the sort of basic production, like, you know, filtering out the rubbish and just, you know, keeping the pure product, turning it into something that you can use, putting it into a supply chain, making an intermediate product, assembling something and making a finished product. They can independently manage that entire process all the way through to design and production. And that vertical integration enables scale, cost efficiencies, rapid iteration, by which we mean rapid feedback. If your customer doesn't like what they see, you say, oh, hang on, you know, you wanted a red one. Oh, I'm sorry, we made a blue one. Very sorry about that. But I tell you what, I can make a red one by you for tomorrow. Because you can speak to your suppliers, they can speak to the people downstream. It's very quick to get that done. You don't have to negotiate across borders with some sort of long-term supply contract. The largest customer base in the world, you know, there's over 1 billion people in China, it's well known. And where also what the Chinese companies have quickly realized, of course, is that they can't be at the mercy of sanctions or tariffs. And so there's been a very strong incentive for them to use domestic suppliers. Even if the technology is not quite as good yet as the foreign one, you're better to rely on the supplier across the road because you can talk to them, the government is behind you, the stuff is reliable, it works, let's get it into our products. The talent pool we've spoken about just now, you know, half the salaries, twice as many coders. It's a very difficult to compete against that. The government and local government, the central and local government are supporting R&D investment. A lot of companies are spending as much as 20% of their revenue on R&D, you know, with support from, let's say, you know, tax breaks or low interest loans that you might be getting from your local government and your central government that allows you to put a huge amount of your revenues back into R&D. And this, again, it's inescapable that eventually you'll come up with some massive innovations, all of which just forms this incredibly intense hard tech startup boom. Lots and lots of small companies, these entrepreneurs, plus the capital that's available to them, they're just coming up with new ideas in artificial intelligence, semiconductors, robotics, new energy, you name it. There are Chinese entrepreneurs, Chinese innovators who are driving the success in this thing. Now, it's obviously, we can't just sort of look at the innovative environment entirely in isolation from the actual macroeconomic environment. Ian, in our previous presentation, again, helpfully mentioned the fact that the sort of regulatory environment in China appears to have relaxed quite a bit. There was a clampdown on various sectors some years ago. Most of that seems to have completely died away, and if anything, it's actually flipped to the other side, where there are a lot more state incentives now for developing, particularly internal substitution of technology. A lot of that is focused on new sectors. There is a criticism that says, everybody's trying to develop solar panels and electric vehicles, and as opposed to being a bit more wide. But there's a little bit of method behind that madness, because if you've got 100 companies all doing solar panels, maybe only 3 or 4 of those will survive, but those 3 or 4 are going to be absolute world leaders because they have had to fight for every yuan in revenue. And therefore, the stuff that they've come up with, the most efficient production process, the most efficient product itself, the most attractive product. So the winners that you get are actually going to, it's very easy for them to become world leaders. We spoke briefly about geopolitics. A lot of import substitution is happening. And then, venture capital exit is a bit of an issue. Is the supply chain of the supply, at least of new capital, a bit limited? Well, maybe it is, but all of this combines to, and again, thank you, Ian, to lower valuations for Chinese companies and Chinese startups. Only the best companies are able to raise money. The innovation is accelerating. There's less competition, arguably, from a capital provider point of view. You can be a lot more patient. You can say, look, no thanks to a lot of innovative ideas, and you can really wait for the next great one to come along. And so as an investor, the landscape is actually very attractive. Now, I do appreciate that the fund that we have on the BCI platform is, it's not so much focused on the venture and startup space, which is where a lot of today's talk has been about. But let's remember that a startup company today becomes a successful public equities company in a short space of time. In the Chinese context, it could be a single-digit number of years, and so a fertile landscape for startups, for innovation, for venture, very quickly translates into some quite incredible opportunities in the public equity space. So I think it's just it's sort of important to bear in mind that even if it's hard to participate in the very early stage of this innovation, that innovation will very quickly carry through into the more established companies. And indeed, like some companies like Tencent, they have an established venture program, right? So they're deliberately participating in and allocating capital to the sector. So there we go. I apologize if I've run slightly over time, but I think it was quite interesting. Eugene or anyone else, if you have any questions, happy to try and address those.
Lars, extremely interesting indeed in China, and also interesting. I mean, at the May conference, one of the presenters made a comment to say, China is either totally uninvestable or the next best opportunity for the next 10 years. So I don't know, pick your poison.
Pick your
from
poison,
that.
yeah.
Exactly. And I mean, there's so much more talk about emerging markets and China specifically. I want to get to your fund specifically. You've got 2 funds. You've got the Emerging Market Fund and you've got the China Equity Feeder Fund, both on our platform and all the big list platforms as well.
Yeah.
With the China Equity Fund, just give us a sense, the exposure that you've got there, is it to mainland China or the Hong Kong shares, or is it a bit of both?
Yeah, it's
And
a
why?
bit of both,
Because if you look
Eugene.
at
So that
yeah,
particular fund is benchmarked against the MSCI China Index, which is a blend of Hong Kong listed shares and mainland listed shares. So you're basically getting an exposure to both. Now, which one of those two is necessarily more attractive actually is a bit of an open debate. A lot of the Hong Kong listed shares are the familiar names that you and I have come across. Tencent not to be overlooked, of course. And also Hong Kong has become there was some drama a couple of years back about Chinese companies listing in the US and whether the SEC and auditing, and there was some stuff there. And what that meant is that a lot of companies actually chose Hong Kong as their initially secondary and now primary listing domicile. And so Hong Kong has just become a capital raising center for Chinese companies. So having a mixture of the two actually I think is quite a good idea.
Yeah, because I mean, if you look at returns, there's been a lot of momentum on the Hong Kong shares because they are the more liquid shares.
Yeah.
But if you look at valuations, the A shares are extremely attractive.
No,
so I like the
that's
idea of
that's right.
getting exposure to both.
Yeah,
So you don't have
yeah.
to pick it. And your fund is also a multi-managed solution. So you're getting a lot of investment ideas in China and with China in your China equity fund.
Yeah, that's right. I mean, those of you who've been on these sort of calls before, you might remember that, that a lot of Chinese managers run very concentrated portfolios. It's important to have a diversity of underlying managers to just make sure you capture all of these opportunities as they come through. So yeah, multi-managing is very much the way to go in a market like China, we would argue.
Definitely a good consideration if you're considering China and the client's portfolio. Lars, thank you so much for your time. We did go a little bit over time, but
Yeah.
very
So it
insightful,
was
very interesting indeed.
And
Thank you
Eugene,
so much.
always good to see you. Thanks, guys.
Fantastic. Ready to go. Joining us now is no stranger to this audience as well, Chief Investment Officer at New Road Capital, Paul Offshore. Good morning, Paul. How are you doing this morning?
Morning, Eugene. Good and yourself? Ready and
Very well,
enjoying
thank you. Paul, I know you're still bullish on the US, but I have to ask why. As I looked at that presentation of Lars on China, but we're all ears, so we're ready for you. Thank you so much.
Great. Thank you very much, Eugene. And thanks everyone for attending. And we know you guys are busy. We know that sometimes us asset managers can talk along and for hours on the same subject. We get very excited. So I'll try and keep this short and sweet and to the 15 minutes. But yes, we're still very much bullish on the US. Before I get into that, from an economic and sort of well, basically an economic investor point of view, I just want to quickly cover just 2 slides on our fund, as we believe it's important to look at performance. You want to be showing, especially over the long term, you want to be showing solid performance against your benchmark and against your peer group. So this is New Road's Global Flexible Fund that we put up here. And the fund is really about, it's not a stock picking fund, it's an actively managed fund, but it only invests in offshore ETFs. So it's a local rand-based fund. And the purpose of the fund is really, it's around being that sort of, it's a global multi-asset carve out designed for a larger multi-asset portfolio. So that's how we view it. So that's when you think about looking at it in the context of a larger portfolio, look at that. So that's what we're really trying to do. So it's flexible in terms of its asset allocation mandates. And then what we do is we actively manage the ETFs, and then we also look at thematic exposures, specifically equity type exposures around that, which we'll talk about now. But you want to see, the fund's almost 5 years old, so it's going to be 5 years old in October. But you can see, so 1 year, 3 year, and 5 year consistent outperformance. If you accumulate that outperformance over time, so it's 4 years and 10 months old at the moment, it's at about a 10% cumulative outperformance versus benchmark. So we're quite chuffed with that, considering that we're not using any kind of stock picking or anything. It's purely just active asset allocation and then using very low cost ETFs. So the fund at the moment sitting on a TR of just north of 1%. For a global rand-based portfolio, we think is very good. So just looking at the quick holdings, some of the themes, and then we'll talk about why we own these. Obviously, our still our core holding is global equities, but we can see we have quite a big US tilt. So we still like US tech. You could say NASDAQ, predominantly US tech. And then we've got some themes around that as well. So semiconductors, for example, sitting at 6.3%. And then, we like the mid-cap space at the moment. We are foreseeing the sort of kind of widening out of US economic growth and the US markets performing. And then uranium and nuclear as well, quite an interesting theme in our portfolio. It's done very well for us actually over the last 2-3 years. So that's the basic holding. Kind of getting into the detail. So the reason we're still very bullish on the US is we think there are a couple of big tailwinds that are coming. Specifically, and to start with, I think interest rates. So if we look at inflation, the fear around the US is still inflation. What are the tariffs going to do now? Obviously, there's back and forth on the tariffs at the moment. They've just been, the Federal Court of Appeals has just ruled them illegal, but Trump's team is obviously going to fight that in court now with the Supreme Court and get a ruling, and hopefully sooner rather than later, because obviously the markets don't like uncertainty. So it has created a little bit of a global sell-off in the last day or two, but we think that'll be resolved fairly soon. But the main risk around the inflation, the main worry around the tariffs is the inflation story. Now, if you just break down the last month's inflation numbers, we're sitting at 2.7% on the CPI basket. If you look at that, about 1.5% of that, these two numbers here are actually primary or residence related. So cost of living, housing related. So the one is the rent of your primary residence, and the one is owner's equivalent rent. Owner's equivalent rent is actually not a real number. They essentially phone up people and say, if you were going to rent out your place, how much would you increase it by this year? So you can see that's actually that has quite a lagging effect on inflation. If we just look here, you can see that it lags inflation quite a lot, because obviously what people do is they take the inflation number into account when they think about what they're going to raise their rent by. So you can see the inflation number spiked here, but quite a few months later, the owner's equivalent rent or the residence inflation actually spikes. And that's still coming down. And you can see it's a lot higher than it has been historically. But if you carve that out and you look at everything else, inflation is sitting at 2%. So if you just remove residence costs and rental costs from the inflation basket, we're actually sitting at 2%. Hasn't been moving at all. The latest inflation print has just come out, pretty much in line with the expectations, and still, you know, pretty much around. It's slightly elevated from where the target is of 2%, but we think that that is quite an arbitrary target in any way. Why 2%? Why not 3? Why not 2.8? You know, so yeah. So the point is that inflation is not running away. It's still very much under control, and it's being driven mostly by this shelter number, really. If we look at what, so house prices, for example, so if we look here, the inflation, the orange line is inflation less shelter, so sitting a bang on that 2%. The blue line is actual house prices coming down. So you can see they are starting to, they've been elevated, sort of raised a bit, and now they're coming down. And the most important thing on this chart actually is really your M2 money supply. Now I've got a quote here saying inflation is always and everywhere a monetary phenomenon, and that's by Milton Friedman, and he won the Nobel Prize in Economics in 1976. And he really was the first economist to come out and say that there's a huge and a massive relationship between money supply and inflation. And I think that's been forgotten a little bit lately. And I think, you know, the prevailing sort of economic models are still very much Keynesian models after John Maynard Keynes. And I think there's probably an ideological reason for that globally, and that is that it allows for more government intervention than Milton Friedman's kind of economics would allow for. We very much monetarists. We believe that we think that the money supply is much more important to inflation than anything else. And you can kind of see it here. You know, his theories still play out today, 40, 50 years later. And you can see this large inflation that we saw here. You know, I mean, if you combine both shelter and non-shelter items, tracks or follows this large increase in money supply. And that really came from the quantitative easing 4, which was where the US Fed propped up its balance sheet from about 4 trillion to about 9 trillion in quite quick succession. And essentially what they did was they indirectly monetized the Treasury's debt. So what the Treasury did during COVID was the Treasury borrowed a lot of money from the public, about 5 trillion, and pumped that into the economy. In and of itself, that would have been okay. It wouldn't have actually increased the money supply. But what the US Fed did was they indirectly monetized that by buying a lot of that debt. Now, it's illegal for them to do that directly. They can't go and buy debt from the Treasury. But what they do is they buy it in the open markets. And essentially, it flows through a bank or something like that. And essentially, indirectly, the Treasury actually pumped that 5 trillion new money into the economy that wouldn't have been there otherwise. And you can see that it resulted in massive monetary growth. And then that has declined. And you can see monetary growth at the moment is actually kind of below long run trends. It's sitting at about 5%, which isn't particularly inflationary. And that's the number we watch most importantly to try and work out where inflation is going. And we just don't see any inflation coming through. You can see, I mean, the money supply growth has actually been negative. It's starting to tick up, but still well below anything before. You know, people ask why wasn't QE1 and QE2 after the GFC, why weren't they inflationary? Well, that didn't result in large money supply growth because what happened there was the Fed, they were quantitative easing, they were injecting money into the economy, but it was going into the commercial banks, and the commercial banks weren't lending it out. So really, to get money supply growth, you need the money actually reaching the end economy, and that didn't happen over here. And Bernanke was actually right; he was correct. So it was a good tool to use back here. But what happens with any good tool as it can almost become a weapon in a way. And now the Fed has realized that, you know, maybe if it worked so well during the GFC, maybe it'll continue to work well, but it was a different mechanism here. And you can see how just kind of in terms of absolute value of numbers, just dwarfed anything that came before it. But number two, done in a very, very different way. Here they were pumping money directly into the balance sheets of commercial banks. Here they were essentially indirectly monetizing Treasury debt. So that's the number you really want to watch. If you want to predict inflation, that's your number there. You can see it's a pretty clear correlation that inflation follows money growth. So that's our view on inflation. So we don't think so. We definitely think there's space for the Fed now. And if you saw the Jackson Hole speech, there's definitely space for the Fed to start dropping rates, and they've become a lot more dovish. So if you're looking at local or US treasuries, we do have quite a lot of exposure to the long run treasuries in the US as well. And if you look, and this is the reason why. So if you take United States, Eurozone, and Japan, these are the actual 10-year yields. So 4.26%, or whatever, at the creating of this presentation, which was a few days ago, but 4.26%, a real rate above inflation of 1.5%, as opposed to Europe and Japan. And now a lot of people would say, the reason that these yields are trading higher is because of the debt trajectory. What's going to happen to US debt? I would argue, I would have a I would question that, and I would say I think that these numbers actually rather reflect long-run expectations of inflation as opposed to fiscal, let's call it fiscal robustness. So, and the reason I say that is if you look at Japan, you would say, okay, well, based on these, then Japan should have the lowest debt. And you can see that Japan by far has the highest sovereign debt to GDP ratio out of these three economies. But its expectation for long-run inflation is very low. And that's why it trades at such a low yield. So we think actually this is providing, probably not saying it's all going to recover tomorrow, but from a long-term view, it's actually a decent investment is to start looking at these yields, because you're getting a 4.2%, and then on the longer end, even north of this number in a hard currency. So yeah, so also like, so we think just with rates coming down as well, you could probably see these rebounding a little bit. And then, in line with the fact that I think expectations of inflation in the US will probably start to dissipate as we see the kind of tariffs rolling through the economy. And it just hasn't been inflationary up till now. And as I said, we don't think it's going to be particularly inflationary going forward. If you look at the underlying economy, so the underlying economy is still strong, but it's starting to moderate. So if you look at the unemployment rate, it's starting to tick up a little bbit. Nothing like extreme yet. We're starting to see definitely not a slowing in the economy. So the last GDP number was actually revised upwards by 30 pips. So it's now, the Q2 GDP was 3.3% growth, which is quite phenomenal actually in the US, considering it's such a large economy. And it'll be interesting to see where that goes. So we still think a strong economy, but remember that the US Fed has got two mandates. It's got an inflation mandate and it's got an employment, essentially a full employment mandate. The inflation mandate vastly under control. You could argue it's not at their 2% target, but it hasn't been at their 2% target in years. We think it's an arbitrary target anyway. As long as pricing remains fairly stable, you're okay. And if you carve out the shelter, you're at 2% anyway. So, and interest rates, I don't think are going to determine what happens with shelter. I think there's other sort of fundamental drivers for that. But ultimately, you've got this sort of unemployment rate coming up. So another reason to kind of view the Fed as being much more dovish going forward, based on Powell's speech, there's probably an 85 to 90% chance that we will get a rate cut. We think they're very late to the game, but we think we will get a 25 pip rate cut in the US in September. So just looking at the last dot plot, and this was before the Jackson Hole speech, you can see that kind of the futures market is kind of trading in some places at a premium to what the dot plot says, and in some places a bit of a discount. So we like these. We think that this dot plot will come down as the Fed becomes more dovish, meaning that they're going to kind of start to look to cut. We think that these dot plots will start to come down. Now, what you can see is they're already on the longer run on the US bonds. They're already trading at higher rates than what the dot plot suggests. So what the own Federal Open Market Committee members are saying, where they see long run yields to be, they are trading at a discount. So we think that discount will widen. And as rates come down, we suspect, and as those inflation kind of expectations come through the system, that you'll start to see a rally, particularly in those longer run bonds. Just on cash, I think anyone who listened to us a few months ago, we were calling quite a strong recovery from the dip, from the Liberation Day dip, which has obviously suited our fund quite well. We've been quite happy with it. We still think it's got legs. And one of the reasons is there's a hell of a lot of cash still sitting on the sidelines in the US. And you can see the cash, as rates start to come down, that cash starts to follow it. Obviously, obvious reasons, your opportunity cost becomes bigger and bigger, and that cash will start to be deployed in other asset classes, aka equities, property, things like that. So, we're expecting that as you see these rates to come down, that this will turn. And you can see record cash. I mean, compared to the last 25 years, just record cash sitting on the sidelines. So, it's been quite a hated rally, this recent rally post-Liberation Day, and this is the reason for it. There's just a lot of money sitting in cash that has not been allocated to capital yet. So I think any pullbacks you do see probably be bought up fairly quickly from a technical point of view as well. So we're both bullish on equities in the US and on the bond market in the US. I'm just looking, people are calling US equities expensive at these rates. What we did here is we're just showing you kind of just this year to date. The green dot is what the markets have done. So what the markets in those countries have done year to date. Okay, but what these bars show you is what has contributed to those returns. So for example, the red would be the earnings contribution, so earnings growth. The yellow would be dividends added to that. This is obviously a total return. And then the pink is your valuation adjustment. So if your PE goes up, then you're getting a lot of pink. So you can see China's had a pretty good year to date, but a lot of it has just been a re-rating in PE. If you see their earnings growth, it's not particularly exciting. Whereas if you look at the Magnificent Seven, for example, I mean, earnings growth, it's actually growth. So even though the total return is about 11, 12%, they've actually derated in terms of valuation. They've actually gotten cheaper in terms from a PE point of view because their earnings have been so strong. And we're seeing a lot of this in the US, and we think you're going to continue to see this going forward. And that's why we believe there's still a lot of legs. There's still a lot of legs in this, we think, in this bull market in the US. Barring kind of short-term uncertainties that you see here and there, I mean, another one, just with the tariff news now, but we expect that will be resolved. But you can see, I mean, you can imagine the biggest 7 companies virtually in the world, or the biggest, let's call it 7 tech stocks, and they're up, earnings are up north of 15%. I mean, Nvidia just released numbers again. I mean, just phenomenal numbers. The market was a little bit disappointed because of future guidance, but their future guidance was excluding potential pickups like China, for example, where there's still a lot of sort of political noise around that. But even if you carve that out, still just phenomenally good numbers. For a company of $4 trillion market cap, it's just incredible what these businesses are able to do, how they're able to leverage their scale and all that kind of stuff. So yeah, very interesting. So whenever anyone tells you, yes, US stocks are expensive, they're expensive for a reason, and that's because they're extremely high quality with high growth, with extremely high earnings growth coming through. And the AI story, we don't think is finished. We don't even think it's really started yet. We think there's still potential, huge opportunity over there over the next few decades. Our themes that we look at are very much sort of long run secular thematics that we look at. So stuff that's got legs that, like what social media would have been in, 2008. That's kind of how we think about it. You can't even picture where the economy or where that industry is going to go because it doesn't exist yet, but the runway is just massive. So just on some of our thematics, we still like semiconductors. So it's an ETF that we own. It's got about 25 names in it. We run a quick sort of like barometer on them every quarter just to see how they're doing when they release earnings. And you can see, I mean, long-term growth, I mean, the earnings beat again. This is the beat. So this was the expected earnings growth, which was already up from the previous quarter. And the actual beat is 8% above the expected number, which is just massive. So, I mean, long-term expected earnings growth on this basket is 20%. So that's a 5-year number. And that keeps getting beaten. So every time these guys release results, that long-term earnings growth is reflected in that. But the actual beat so far is that. So that's so just show you just a huge amount of momentum and a huge amount of just like sort of secular tailwind behind these industries. At this stage, 21 of the 25 had reported, but Nvidia actually, funnily enough, hadn't reported yet, and it came out and also beat estimates. So pretty much the whole basket beating estimates. If we look at uranium and nuclear, it's been another great holding for us for a while. Just shows you kind of with AI, it's also sort of related to the AI trade. You've got these data centers, you've got these hyperscalers requiring huge amounts of energy. The best way that they can get hold of that energy is actually through nuclear. It's the cleanest and the most sort of reliable form of energy that they can, and they can also modulate it. So they can segment it to what they need. So it's very, you got these modular reactors now that you can kind of almost bespoke design your own little plant to power your own data center and things like that. And with where AI is going, it's just that demand for data is just becoming more and more. So you can see, this was just kind of where nuclear energy was kind of being, or the investment in nuclear energy, how it's been, and you can see just the last few years that like just ramp up. So I mean, it's pretty much doubled in the last 5 years, and we expect this to continue. So if you look at just estimates, longer run estimates, you can see, I mean, on data center power demand alone, it's just starting to, I mean, it's expected to double, triple over the next few years. So we still just think massive drivers there as well on that technology. So yeah, that's kind of it. I wanted to keep it short and sweet. I know you guys have got a long conference today, but just a couple of sort of news articles on data center investment and things like that as well. So yeah, that's us. We're still very much bullish. We think just on the US, you could argue that it's a bit of a contradictory kind of viewpoint at the moment, but you know, so far it's definitely been playing out, and we don't expect that's going to change anytime soon. So, you know, we've been right up till now. We think we're going to continue to be good on this one. So, but you know, that's the importance of not trying to over focus on stock picking as well, and just look at thematics and look at areas where you think you can add value, and keep the process very simple, and that's what we try and do. So thank you. Thanks for your time.
Paul, you're 100% right. When I looked at your presentation beginning of the year, I thought, ooh, okay, let's see how it plays out. But you're 100% right. You were right. Just a quick question, one question. Very bullish on equities, as you illustrated. You also mentioned bonds. You do have a high allocation to offshore bonds, but why then still have US bonds?
We just think US bonds are offering good value, and you know, we multi-asset, so we like to hedge our bets. So if you know, if you do see some kind of shock externality, let's say excluding you know, US specific, like an inflation story or something like that. I'm talking like a pure externality. Let's say, I don't know, a freaking asteroid hits California or something, who knows? We think that the old relationships will still play out. So we think you'll see negative correlation between US treasuries and US bonds. So they're a good hedge for us. They are offering us a decent yield. We also think the dollar's probably quite weak. We think it's artificially weak at the moment. So if you see like dollar strength plus, you know, you're getting a 5% yield on those longer end bonds, it's actually not a bad, it's quite investable now. It's not like it was 5 years ago. We virtually got zero yield. So we think it's a good hedge. It's a good risk mitigator in the portfolio. You can see US treasuries here sitting at about 17%. So we just think from a risk management point of view, it's prudent to have. And that also, you know, if you do get any kind of short-term kind of shock, that it will protect. I didn't do that during Liberation Day, but we think there were different mechanics going on there.
Exactly, and I mean, if you do see a cut or two or three, who knows? Bonds will obviously benefit from that a little bit further. So very interesting indeed. Paul, thank you for the time this morning. Yeah, exactly. Thank you so much for your time. Very insightful and very interesting how you construct your portfolios as well, and keeping the costs down, obviously, in a well-managed solution. Thank you so much.
Thank you, Eugene. Let me see.
We're going to continue with global value, and it's my great pleasure to welcome a newcomer to our platform and to our audience, all the way from London, Tom Bilby, portfolio manager at Arcadian. Tom, you guys might be new to a lot of us, but you've got a long history and a proven track record going back, I think, to 1986. So I've been doing very well indeed. Thank you so much for joining us this morning. It's really great to have you on board, and looking forward to your presentation.
Thanks very much, Eugene. So I'm just going to speak for a couple of moments. I work alongside Tom. We both work for Acadian. What we're going to do to start with, I think we're able to use a poll question, aren't we? So if somebody could bring up our poll question, we'll cut straight to that. Oh, look at that. Here we go. So if people could read this and answer it, how would you rate your driving skills compared with the average person? It would be fantastic if you could just complete that, please. Okay. Fantastic. Well, the results we've got here are very typical of a tried and tested example of a question that demonstrates a behavioral bias at play. Clearly, if you ask everybody in the world this question, you should get an equal distribution of above average and below average. But very typically, this doesn't happen. And this is exactly what, if we look at slide 5, Tom, you'll see an example of overconfidence bias, which us as systematic investors try and remove from our investment process. On slide 6, you'll see other examples of common behavioral biases, including loss aversion, where investors do not want to sell positions quickly, even if they shouldn't be holding them anymore. Another is herding, where investors are worried about missing out on a popular theme, so go into potentially crowded trades. With this in mind, who are Acadian and what do we do? Tom, if we could just flick to slide 3. We're a systematic investment manager, meaning that we use data and evidence-based economic rationale to decide what stocks to buy in our portfolios. So we're based in Boston, which again isn't a coincidence. Boston is home to many of the leading universities in the world, so we have direct access to some of the academics that come up through the Boston ranks. You can see here that we have over $150 billion of AUM that we invest on behalf of predominantly institutional, but more and more also retail investors that believe that systematic or quant investing is the way to go. Included in this number is nearly $1 billion from the South African market, where we're slowly starting to penetrate more. And this is helped by the fact that we've delivered strong outperformance across all medium and longer term time periods across our global equity portfolios, whilst also incorporating ESG and sustainability throughout our process. Tom, if we move to slide 7, I'm just going to comment briefly on some of the traits which are sometimes associated with systematic or quant managers. Whilst not having time to robustly to spell each of these in turn, I'll touch on a couple of points here. So one of the myths of quant investing is that they're all black boxes. This absolutely is not the case for Acadian, and we'll bring that to life today to show you underneath the hood and get quite transparent in terms of our investment process. Some believe that quants are backward looking in nature. Well, of course, we do use data that is backward looking or has happened in the past, but this is used to forecast forward looking metrics in terms of the future returns of stock prices. And this has been done very successfully by us over 40 years. The next one is that they never rely on human judgment. This is not accurate. What we don't do is we ensure that we're not prone to the same behavioral biases that some discretionary managers do. And instead, our human judgment is more in terms of the oversight of portfolios and the research techniques that we employ to find efficacious signals in terms of going forward. Tend to result in passive portfolios? Absolutely not. Although our portfolios do have typically hundreds of names in them, they're definitely not passive. The active shares, so that's the percentage of the portfolios that are not the same as the index, is typically in the region of 70 to 80%. And the fact that we've delivered meaningful net of fees alpha, so outperformance over the long term, demonstrates they're not passive portfolios. And the last one here is that some believe that they're all the same. This is, again, not the case, because you can see this from our proprietary definitions of signals and the fact that our performance is very different from both the market and our peers. So with that in mind, I'm going to hand over to Tom, who's going to talk you through our investment process and try and bring this to life. Thanks, Tom.
Sure, thanks, Ollie. And we've got I take it about 15 minutes to run through this. So I'll keep it relatively high level. But I suppose what I want to do is talk you through how do we exploit those behavioral biases that Ollie referenced. So I've got one slide I'm going to talk through, and then what we're going to do is we're going to show you the model, and we'll look at a stock, and I'll really get into the weeds as to the kind of things that we look at a company level. So before I do that, just take our investment process as this. Effectively, we start collecting data on a lot of companies. So our investable universe is close to 45,000 companies. And data can be things like financial information. It can be from alternative data sources to like text or news articles. But we collect lots of data on lots of companies, and then we use that data to form what we call a return forecast. So think of it like this. For each of those 45,000 companies, we have a view whether that stock's going to out or underperform over the next 3 to 6 months. So we're very much taking a medium-term view on each of those 45,000 companies. We then use what we call portfolio construction techniques to build portfolios for clients. And to reiterate the point that Ollie made, those portfolios are very, very diversified and risk controlled, but still high conviction. Think of it like this. We buy or take bets across a large number of companies that we like on our model, but we ensure that we're diversified so that not one stock is driving our returns, but our returns are coming from buying the right kind of companies. And then the last part of our investment process, again, to reiterate the point Ollie made, is that when we're interacting with the marketplace, there's still human oversight. So my job as a PM at Acadian is very different to that of your traditional discretionary managers. I'm there to help risk manage and risk control our portfolios to ensure that we're delivering that high conviction, high expected return portfolio for our clients. So that's in a nutshell, from a very high level, kind of how our investment process is structured. What I really want to do, though, is show it to you and show you a forecast on an individual stock. And I'm going to jump to another screen and I'm going to zoom in a little bit so that you can see it. And what I'm going to do is I'm going to talk you through our forecast on Alphabet, so the parent company of Google. And we like Alphabet. And the reason I know we like Alphabet is you can see one number, the top right-hand side here, which is what we call our final forecast. That's our return expectation for Alphabet over the next 3 to 6 months. And it's plus 1.34%. You've never seen that number before, but I can tell you that's a good score. Anything above 1%, we typically view as a very attractive stock on our model. So we like Alphabet. Why do we like Alphabet? Well, our forecast comes from 3 things. We form what we call a top-down view. So that's a data-driven view on countries and industries. And right now, for US media, we're marginally positive. So 0.4% of our forecast is coming from the fact that we like US media. Below the surface, I can tell you we're actually a little bit negative on the US, but we are very positive on media. And particularly within the media segment, we think US media looks very attractive. So we got a nice little top-down boost for Alphabet. That would be the same for any other US media company. So it's not stock specific. The next part of our model is looking at what we call peers. So for Alphabet, we form a group of companies that we think are very closely linked to Alphabet. We'd call them peers of Alphabet. And then we look at our return forecast for that group of stocks. And if all those stocks look great and it looks like there's a good opportunity to invest, that helps boost up our forecast for Alphabet. And we're doing that, building that ecosystem of stocks for every one of the close to 45,000 companies that we're covering on our model. And you can see that there. We're having 0.39% of this 1.39% forecast is coming from our view on the peers of Alphabet. But the bulk of our forecast comes from what we call our stock-specific model, or bottom-up model. And what we're doing there is assessing Alphabet across 4 key metrics or 4 key areas. We look at valuations. We look at quality, we look at growth, and we look at the technical backdrop. What does that mean? We're trying to find attractively valued companies. We're trying to find high-quality businesses. We're trying to find businesses that we think are going to continue to grow. And finally, we look at the price performance or technical backdrop to understand whether it's a good time to be investing in that company. So in the case of Alphabet, we think this is a very expensive stock. So you can see a negative number here. Our forecast is lower because the valuations on Alphabet look challenged. But what we do see is that it's a very good quality business. It's got very good growth prospects and the technical backdrop is positive. So in other words, the top-down view, the view on the peers, and the majority of the fundamental signals are telling us that Alphabet is a very good investment opportunity right now. Now, that is at a very high level. What does the model actually look like below the surface is what you see in these colored areas. So each of the colors, the first 3 lines, if anyone's colorblind, in blue, represent the value factors that we're looking at. Quality is the next 5 lines in green. After that, in red, the subsequent 5 lines are growth. And then finally, this last section in yellow is technical. So what we're doing is for each of these areas, whether it's valuation or quality, we're looking at different ways to assess whether Alphabet is a good quality business. So for example, there's a line here that says asset quality. That's where we're looking at the balance sheet and assessing whether this company is in a strong state from a balance sheet perspective. There's other lines that look at different things. So for example, we look at the quality of the management of the business. Now, if I click on just one of these examples, and I will pick on the management behavior example, how do we as systematic managers assess whether a company is well managed? We're looking at 45,000 companies. Clearly, we're not meeting with the management of all 45,000 companies. So we have to use data to tell us whether it's a well-managed or well-run business. So what do we look at? You'll see when I've clicked on this line for management behavior that there's lots of different signals that have popped up here on the right-hand side. Let me just give you a snapshot of the kind of things that we're looking at. So we look at the quality of the board. To do that, we assess or look at the CVs or the backgrounds of the management of the board members and look if they've got relevant experience. We look at the ownership stakes. the CEO and the top management team have in the business. We're trying to find companies where the management team are aligned with us and incentivized in the same lines as us as investors. We also look at completely different things. So, for example, we'll go online and use natural linguistic processing, so kind of cutting edge AI, to read the reviews that employees are writing about working for Alphabet. And if all the employees are talking positively about Alphabet, that to us as investors is a good sign. That tells us it's probably a well-managed company. It tells us that investors or employees feel rewarded, feel satisfied with working there. And the list goes on. You can think of it as lots of different quantitative ways of assessing whether we think the management or the structure of the management at Alphabet is a good, bad management. If I jump back to this table on the left-hand side, you'll see a column here called score. And what we're showing you here is how does Alphabet look on each of these lines? So in the case of management behavior, you can see a positive score. Let's ignore the magnitude of the numbers, just view anything as positive and being a stock that we like. So we would argue that Alphabet is a well-managed business, and that is helping boost up our forecast. I told you before, we like the quality of Alphabet as a company, partially because we think it is a well-managed company. But we also look at things like the cash flow position or the corporate strength of the business. That is also positive. So what we're combining is qualitative ways of measuring whether it's a well-managed business with more traditional fundamental metrics. The list goes on. We can go across all the different sections, but the idea is that there's well over 100 individual signals that we're aggregating together to form our forecast and our view on Alphabet. Now, Alphabet is a US media company. If we were to go to South Africa and look at a South African stock, you'd see the same structure of model. And this is a really important point. And this is how we can have a forecast on so many companies, because we use the same model everywhere we invest. But what we do, and this is a really important driver of how we can add value for our underlying investors, is we don't treat all these things equal. Now, in certain markets, some of these factors or themes have worked better than others. So, for example, in the US, you would be unsurprised to know that things like quality, growth, technical signals have typically been a better predictor of returns of stocks than valuations. And you can just look at things like the Magnificent Seven. Those stocks, objectively have looked very expensive, very long period of time, but have been an important driver of the US equity market. So we'd want our models to reflect that. If you go to emerging markets, for example, what you'd see is actually valuations are much more important at predicting returns. So think of our model as being one structure. We're looking at all these things the same, but then what we're doing is we're really tailoring it to where we're investing. And that's what's been able for us over a long period of time to deliver very successful returns for our clients globally, whether it's in emerging markets, whether it's in global developed markets or regional equity strategies. So that is a very brief introduction into our models and how we forecast returns. I thought what I would touch upon, and having listened to a couple of the other presentations very briefly, is what are our top-down views right now? So I told you part of our forecast is coming from having a view on countries and having a view on industries. I thought it would be quite interesting just to touch upon some interesting attributes in our models. So these forecasts that we're forming are not based on economists that we employ or discretionary views of portfolio managers. They're viewed coming from the data itself. So we do a similar exercise. We look at countries, whether they're expensive or cheap. We look at the quality of countries. We look at the momentum in countries, and we use all that information to form our views on whether we like the US or dislike the US. And for us right now, actually, we're marginally negative on the US. We think there's better opportunities in other countries. So, for example, for us right now, China looks like an attractive opportunity from a country perspective. We are actually positive on Switzerland, which is a relatively small European market, but still important from a healthcare perspective. And then we're marginally positive on a number of other emerging market countries. So, for example, some of the GCC, so the Gulf countries, also look very positive on our model. On the flip side, where we are right now from a view perspective is we're very negative on India. So within emerging markets, we view India as one of the kind of the worst looking countries alongside Turkey. And from a developed market country, we would point to Canada as probably being one of the largest that we expect to underperform over the next 3 to 6 months. To close out on an industry perspective, Similarly, we form views on industries. We are very positive on banks right now. Banks is one of the top ranked industries within our model, but we also remain very positive on tech, semiconductors, and media. So the traditional, large tech US type parts of the market look very attractive on our models. On the flip side, we are very neutral or very negative on more defensive sectors. So household products and food, bev, and tobaccos do look very negative alongside pharma and healthcare services on our model. So I'm going to stop there. I think we're pretty much up on time in terms of the presentation. That was a very much whistle-stop tour, an introduction into what we do and how we do it. Happy to pause Eugene to take some questions if you have any.
Tom, thank you very much for that, very insightful indeed, and thank you for sharing that process. I think it gave us a lot of insight as to how you manage your fund, how do you look at the world, a lot of factors coming into play, stuff that we don't normally see. I don't have any open questions from the audience. I think it was a very good introduction to Arcadian, and looking forward to seeing a lot more of you in years to come. Thank you so much for joining us this morning.
You're welcome.
Thank you.
Right, we're moving on and we're going to look at global equity flexible funds. And it's my pleasure to welcome JD Hayward from Flagship Asset Management. Flagship manages various mandates, including a global flexible and worldwide flexible fund. JD, it's going to be very interesting to see how you allocate to these flexible funds at the moment and the process you follow. Thank you so much for joining us.
Good morning, Eugene. Thank you very much. Everyone. So my name is JD Hayward. I am co-manager of Flagship's global strategies along with my colleague Philip Short. Just as a brief introduction, we are a Cape Town-based boutique manager. We've been around for almost 25 years. We are a global first manager rather than local, who then diverged into global. And we offer three distinct global products: a pure equity fund, a worldwide flexible fund, which I'll be touching on today, and then a fund of funds. All right, so let's get straight into it. Markets today are quite expensive, somewhat volatile. There's a lot of uncertainty. So how do you navigate this in a flexible fund mandate? On the screen, we have the blended forward PE ratio of the MSCI ACWI over the last 20 years. The dotted line would be the median value. Solid lines are one standard deviation above and below the average. What this chart shows us is that the ACWI, on a blended forward PE of 19 times, is currently at a 30% premium versus its 20-year median. Now, the previous time I did one of these roadshows was back in February. The MSCI ACWI back then was at 18.5, so almost at the same levels as today. Now, this is quite expensive. In the meantime, though, there's been a lot has happened in the market. So we had a pretty sudden and steep decline amid trade wars and tariff turmoil. But today the ACWI is about 8.5% higher than it was in February, so close to 16% annualized, and on track for another pretty strong year. This has all been happening while there's been a constant stream of both positive, but also actually more negative data points being released. So on the positive side, it's been massive earnings upgrades pretty much across the board for the S&P. On the negative side, though, there's been some large negative job data revisions. We've seen an increase in PPI, so that's potentially in the supply channel towards CPI. And then we've also got negative signaling coming out of certain industries like transportation, FedEx, UPS, those types of guys that generally have visibility into demand. So what does this mean? The main takeaway from the previous presentation, or the previous one I did, was basically the importance of maintaining a fairly high equity exposure in a flexible fund. And one of the big reasons we looked at in that presentation was the effect of trending markets, both up and down, and how that can be the case for much longer than seemed rational. Today, we'll take a look at another factor, sort of through our top-down lens, that we take into consideration when maintaining high equity exposure in expensive markets. Before we do that, though, just take stock and see whether all markets are as expensive, or are there still some pockets of value out there. So in this chart, we've got a range of PEs for different markets over the last 20 years. The red column basically just represents the 10th to 90th percentile of data. So the bulk of all observations would fall within those, or within that area. The white dot is the median PE over the time, and the blue dot is the current PE. And starting on the left with the US, it's clear that that market is expensive. Same for ACWI. Both PEs currently outside of their 90th percentile range. Europe looks a bit better, but still quite expensive actually. Japan and China appear to offer better value at this stage, with current PEs being much closer to their long-term median. The standout here is actually South Africa, where equities are trading below their long-term median. One has to keep in mind, though, that especially for the US and ACWI, that an equal weighted version of either of these indices would be a lot less scary, because both are dominated by a handful of companies on very high multiples. The top 10 ACWI positions, for example, represents about 24% of the index's market cap. Those same 10 positions in our portfolio is only 10%. So we are significantly underweight a number of those expensive stocks. So when people say markets are expensive, they generally refer to the US, but not all markets are that expensive. And even among the expensive ones, there are still some decent value and bargain stocks on offer. Being global investors, we have the ability to capitalize on all those opportunities. So given those valuation levels, how are we positioned today? Early in Q1, we were running at close to 90% equity, which we reduced late in Q1 as tariffs introduced some turmoil into the market. However, during Q2, we have again significantly increased equity exposure to where we sit today, roughly 84%, with the balance split equally between cash and gold. So with equities being the biggest allocation by far, let's dive into that one first. And earlier I said that we'll look at another factor we consider when maintaining our high equity exposure. So enter the global money supply. So in this chart, we've got global liquidity in red on the left-hand side, and we've got the S&P 500 in gray on the right-hand side. The global liquidity in this case is measured by the M2 money supply of the 13 largest central banks around the world. So just a quick definition there on M1 and M2. M1 can be thought of as the most liquid form of money, so cash, checking accounts, etc., money that's actively circulating in the economy. And M2 is a broader measure, so includes all of M1 plus near money assets like money market accounts, etc. So M2 in simple terms is how much potential money there is going around in the economy. Rising M2 often correlates with higher demand for risk assets, as this increase in money supply often finds its way to riskier assets like stocks, cryptocurrency, corporate debt, etc. Great example of this would be post-COVID stimulus checks that were distributed. This combined with loose monetary policy at the time, the very low rates, that led to a large expansion in M2 and the ballooning in retail trading volumes. Now, there are different ways for the Fed to manipulate the money supply in the system. So we can have normal rate adjustments, you can have quantitative easing or tightening, adjusting of reserve ratios, but there's also the possibility of yield curve control. Now, yield curve control and QE are both tools available to a central bank, in this case, the US Fed. Different tools, different mechanisms, but to some extent aim to do roughly the same thing, which is generally to drive yields lower on the longer end of the curve. So yield curve control basically targets a specific maturity on the curve and then buys and sells as many bonds as necessary to hit that target rate. This, of course, dramatically different from the Fed's normal MO of setting short-term Fed fund rates. Yield curve control, could be an option if near-term rates are already at levels seen to be restrictive or near zero. QE, on the other hand, focuses more on an injection of liquidity into the financial system through large-scale sort of purchasing of bonds in the open market. Bids up the price, which lowers the yields. So QE is somewhat more open-ended and aims to almost affect overall financial conditions where yield curve control targets a specific yield to affect long-term rates. I might think, okay, this is somewhat interesting, the correlation between the two, but surely it doesn't hold over long term. Let's take a look. This is the same chart, but over a 15-year history. It's not a 100% perfect fit, but certainly a pretty high degree of correlation here. In fact, there is a higher correlation than what we see with either earnings growth or GDP growth. So if this increase in M2 is good or supportive of stocks, where do we find ourselves today? Currently, we are amid another cutting cycle, with the US likely to join this party in September. The red line on this chart represents the percentage of central banks. Its last move was a cut on the left-hand side, currently at about 80%. And the gray bars is the net proportion of central banks whose last move was a rate cut but GDP weighted. So without the GDP-based weightings for each bank, they would all have equal, or seem to be having equal influence in the calculation. Whereas obviously the GDP-weighted one gives a higher weighting to the Fed, as an example. So the higher this proportion goes, the more central banks are cutting rates, which could help improve market liquidity. There's in fact been 91 central bank rate cuts this year, which is the fastest cutting cycle since 2020, which was in the midst of COVID, so probably a bit of a skewed number. This table is just a sample of some major central banks that have been cutting since March last year. The only exception here being Japan, which has actually seen a small increase in rates. So up until now, I've only looked at equities, and why we believe for the time being fairly high weighting towards equities is still the right call. But given that this is a flexible fund, I'll quickly run through some other notable weightings in our portfolio. And the first one I will look at is gold. So we've got a fairly chunky holding, around 8% of the portfolio. Been big fans of gold for quite a while now. So why is this the case? Gold remains the only truly risk-free asset. While treasury bills are deemed safe, we've seen with geopolitical events that this is not necessarily always true. One of the biggest drivers for gold's strong performance over the last few years came after the US seized Russia's US bond holdings after the invasion of Ukraine. This led to a number of countries, notably China, selling their US bond holdings and stocking up on gold. Gold is obviously well known for its safe haven properties during times of uncertainty we are currently experiencing. Trade wars, this one is fairly self-explanatory, just another form of uncertainty in the market. And Trump has shown that he's certainly willing to use tariffs to try and negotiate better deals for the US. We think that data seems to point that there might be an increasing likelihood that we could move towards a stagflation environment where gold will definitely provide protection. And lastly, the diversification benefits are obvious. Next up, if we take a look at bonds, we currently have 0 bonds in the portfolio. Why is this the case? First one, US debt, currently sitting at, or just recently breached, $37 trillion. And there's seemingly no end in sight to this ballooning deficit. Currently running more deficits during a time or a period where we had economic expansion and low unemployment. So you would, expect reasonably to be running at a budget surplus. Inflation. In recent months, we've seen an uptick in inflation numbers, but certainly some warning signs of a second spike in inflation remain. Tariffs. The effect of this, to some extent, still unclear, but certainly has the potential to put more upward pressure on inflation. Political interference. This has been front and center over the last couple of days. all kinds of meddling in the Fed's affairs, which introduces more risk into the system. And that all of these points that I mentioned are basically so high debt, high inflation, political interference, all mean that that investors will feel there's more risk in the US system, whether sort of real or perceived, but they'll typically require a high yield to be compensated for this high risk. And then lastly, since about September last year, we've seen a decoupling of short-term rates and long-term rates in the US. So short-term rates, start to move down, while long-term rates have actually increased further. So the signal here would be that the market is not quite convinced about the Fed's trajectory, or at that time at least. Now, we could be wrong on some of these, absolutely. So, which factors are we sort of watching to, or that could cause us to adjust our allocation? First one is inflation, hottest topic on the block at the moment, and opinions quite divided. Some mitigating factors, would be something like lower oil prices on increased OPEC output, but exacerbating factors like tariffs, even though not 100% clear yet, still remain. Bond yields, currently not there yet, but depending on what yields do, investing in bonds could become more attractive going forward. Rate cuts. After Jackson Hole, the market is now putting roughly 85% odds on a cut as soon as September. But then we've got increasing PPI, which puts some pressure on that outlook. The US Treasury could potentially get much more efficient with its fiscus, decreasing wasteful expenditure, leading to reduced debt levels. And that subsequently could lead to reduced debt to GDP levels. So investors might be satisfied with a slightly lower bond yield, leading to demand and rise in bond prices. And then lastly, after a few years of QT, we could potentially see the return of QE. Now, in this situation, equities will also do well, but given the starting valuations, probably not as well as bonds. Okay, so I've now taken you through our thinking and reasoning behind current makeup of our flexible strategy. So why do we think we at Flagship are well positioned to capitalize on these views? The first thing I think is, we've got an active risk management system that forces us to take bias and emotion out of our decision-making process completely. This in turn allows us to run equity-centric portfolios. Equities have, over the long term, proven to be the best performing asset class, which is why we believe it's crucial to run with a structurally high equity exposure, even though we know markets are expensive. Our portfolios are unconstrained, allows us to capitalize on the best opportunities we find wherever they are. We've got a nimble approach, which allows for substantial changes to the portfolio within a day. So it's not, a bunch of red tape and bureaucracy. We can make decisions and act on them quite quickly. We are truly global. So South Africa accounts for less than 1% of global GDP. There are entire industries, aerospace, defense, IT, to which we do not have access on the local market. And we want to offer investors, the best opportunities in those industries. So we take a truly global approach. And then lastly, experience. We've been investing globally for over 25 years, over which period we are one of the most awarded boutiques in South Africa. And then just lastly, Phil and I took over management of the flexible strategy just over 2 years ago. We set about implementing our process and philosophy, and the subsequent results have been very promising. The fund has outperformed both its benchmark and the average of the CISA category over that period, returning 15% annualized. Since that date. And that is my story for today, Eugene. Thank you very much.
Jody, thank you so much. Just one question very quickly. In a true worldwide flex mandate, Your views currently on global equity versus SA, because I mean SA equity really stands out, and it served clients extremely well the past 12 months. Just in short, underweight, overweight.
So if you're underweight or overweight and you compare it to equities, very hard to be underweight. We generally do not invest locally. We've got one holding locally, which is Blue Label. It started out quite small in the portfolio, and it's grown organically to be quite a big part of the portfolio. But I mean, we generally tell investors, and that's what they come to us for, is for global exposure. So we go and look for global opportunities. Yeah.
Very specific reason why I asked that question, because if you look at that category, it's a mixed bags of tricks. So you need to understand what you're buying, and with your benchmark being equi, understanding that you're buying a global buyers fund, but risk mitigation obviously of key in your process. And interesting to see how diverse views can be on certain aspects of the market. So who's right, who's wrong? It's not for me to say. It's all again about diversification in client portfolios. Jody, thank you so much for coming on board this morning. We really appreciated your time. Thank you.
Thanks, Eugene. Bye.
Right, at the ready to go, our second last presentation for the day. We've got Rob Ollerman from Laurium Capital. They're appointed as the fund manager on the BCI MI Thornbridge Global Opportunities Feeder Fund. Rob, thank you so much for joining us again. Really good to have you on board. For the audience that doesn't know Rob, he's been in the industry for decades now, not trying to give away your age, but you are an extremely well-experienced fund manager, ex-Allan Gray, ex-Coro. And if I look at your performance beating the MSCI Acqui hands down, I think a lot of that knowledge and skill is coming to the fore. Rob, it's really a privilege to have you again with us this morning. And with that introduction, I'll hand it over to you.
Thanks, Eugene. Nice, kind introduction, and quite exciting to be back on the BCI platform. It's been a while, and it's really nice to have this mandate that we won in November 2022 as Laurium Capital. So I'm going to skip through some of the fund specifics to the extent that I can, and try and spend a bit more time on the content of the fund and how we think about the world at the moment. It's really interesting listening to some of the other presentations. You can put the same inputs into so many different investment management brains, and you get such a range of methods and views. So hopefully our approach will resonate. We pride ourselves on being quite commercial and common sense, I think, oriented in our fund management style. Laurium itself is, the company that I'm representing. We've been around for 17 years as a business. Still, very much a boutique mindset, nimble, all those good things about being small. But I think we've also earned our reputation by being very disciplined and having a strong bottom-up process. Just a slide on the fund. Yeah, so if you just see the headlines, Thornbridge, I think for a lot of the South African audience, you probably wouldn't have heard of the fund name. Thornbridge is the investment management company in the UK. The fund itself has been going since 2004. So it has a long track record with two fund managers, successful fund managers before us. And we were appointed in November 22. And I can show you some of the performance stats of the fund since then. It's a UK OIC, but very nicely has this BCI feeder structure now for South African investors. And it's really nice to see the support that we've been getting in that guise. The fund itself is about £300 million. And Laurium, myself and the Laurium team, we're managing just over $500 million of global equity assets in this specific active mandate, and have had, as Eugene says, a nice track record of success. It's an unconstrained portfolio. Bottom-up stock picking, I would say it is quality at a reasonable price. So if you look at the fund signature, it screens as quality as a reasonable price, and there's reason why that is the case. We are not, our process doesn't start with valuation. It starts with looking for really good businesses that we can invest in, with strong management teams, a kind of moat around the business in terms of product or service, and a duration to that, exceptional financial returns out of that process, and something enduring that we feel we can invest behind. So very much more an investor first mindset, as opposed to sort of bobbing and weaving amongst the waves of the market. And hopefully my presentation will show you some of that in action. There's been a lot of talk around macro noise, and I'm sure a lot of the presentations today will have given you a great background into how tricky the macro environment currently is. It's as challenging as any, I think, that we've all faced, with particularly the US leadership, kind of global economic leadership in question, and the political leadership providing us lots of challenges. But there's lots of opportunity still to invest. And even though markets have run, and it's been referred to, I think, in a couple of certainly the recent presentations, markets overtly look expensive, we still find that there's a lot of commercial opportunity that the companies themselves are still pretty much in the early days of exploiting. Now, some of the judgment that we are being forced to exercise is how much of that commercial runway has already been priced in by markets. But I just wanted to take the audience through these sort of 5 areas where I would say we focused our research team and our efforts. I like to kind of focus the energy in our team in areas where there's change, and big change, which I think markets struggle to price quickly and effectively and efficiently. And maybe that's the opportunity where there's more sort of mispricing coming into the market. Technology shares the obvious one, where there's such a high pace of change normally. One needs to be really up to date with what's going on there to understand some of the commercial dynamics. And I would say just NVIDIA, which has been referenced a couple of times in the presentations today, is a great example of how the market presented with a set of facts for a business which was going from 10 billion of AI turnover just 18 months, 2 years ago, to $200 billion of turnover for this calendar year, likely in that space, has just really struggled to price that, and immediately just everyone thinks it's expensive. And there's yet a lot of tech innovation, we think, particularly in cloud migration and the AI infrastructure, and then the hardware stack around that we still think is investable and interesting, and is still represented in our funds, not necessarily in NVIDIA, but in a company like Broadcom. The electrification and power requirements are, big and growing. The US is kind of the phrase is looking for every electron they can find, and that process is ongoing, not just in data centers, but everything has a plug these days, and the renewables tie in. So there's a lot of opportunity there. And we invested not just in the generation companies like a GEV or Mitsubishi Heavy with the turbine manufacturers, but also in Quanta, which has been one of our stalwart holdings in the recent past and continues to be that. And then something is often, I think, overlooked in the pharma sector. We've been very interested in the oncology drug area, where there's been some really good innovation that's come through in oncology drugs in the last 4 or 5 years now. I think the pharmaceutical space is very challenging for fund managers and analysts to invest behind, because it has, for good reason, a kind of a long scientific runway which you need to traverse to commercialize your knowledge base. But we've moved from a process on kind of oncology drugs, from chemotherapy, radiation therapy, to these antibody drug conjugates, immunotherapy, where these oncology drugs are certainly presenting an improved alternative to cancer patients, and we see quite a long runway of commercialization opportunity in that for a company like AstraZeneca. Obviously, there's a lot of talk about obesity drugs, but then the other thing that's also happening is that there's a lot of older drugs which are falling off patent in 2028, one of the biggest patent cliffs that we've seen, and that's been a really interesting part of our recent research as well. The financial sector is probably the one area of the market which you might not expect to find well represented in a quality fund. So I think many people assume quality at a reasonable price starts and ends in the consumer goods sector, typically FMCG products. We are prepared to rent the exposure in areas of more kind of cyclical exposure, and certainly in the financial sector. I would say Donald Trump is a human yield curve steepener. We're seeing the impact of that now at the short end. Obviously, in Europe, the short end of the yield curve is always looks like it should go to zero in that economic museum. But in the US, they're also very keen to obviously cut rates as soon as the inflation environment looks benign, as it currently is. And under those circumstances, banks, typically they're borrowing short and they're lending long. It's really good for margins in banks, and we've seen really good opportunities in commercial banks. And then on the advisory business, it's also sort of giving us an opportunity as well. So we've got more financials in the fund than we might have had in the past. And then commodities, primarily precious metals. It was referenced in the presentation earlier on. But precious metals have been an important part of us mitigating geopolitical risks in the fund. And so in my bucket of the fund that hedges some of the views that we take, we've had some gold exposure, gold mining exposure, which has done really well for us in the recent past. So if I look at where we haven't been, I think it's as important, and I recently wrote an article on this, on some of the underweights. People, I think, often speak to their book on the overweights, but I think on those sort of underweights, regulatory challenges. Obviously, the tariffs take headline news all the time, but the tech platforms have been facing that. And just last night, we saw the remedies in the Google versus Department of Justice case in the US. Funnily enough, it's really weighed on that sector for quite some time, and it's been a real challenge for us. And we do own some Alphabet exposure, Google, and you'll see that share rally today because it's really best case outcome, I think, for Alphabet in terms of the remedies in that case. But what's not over yet is, all the restrictions around chip movements and wafer fab equipment movement. Some of the green energy incentives, Trump's still shutting down wind farms, etc. So it's been a very challenging regulatory environment. And then on the consumer side, there's cyclical headwinds, a lot of them still. I don't think we're bullish on spending power of the consumer in general, but there's also structural shifts, some big structural things going on. And I'm not going to spend much time talking about it, but just different habits with different parts of society. And every time you hear a staples company missing earnings expectations, they're blaming macro weakness. But I think that there's also a lot of structural underlying shifts going on and habits changing in processed foods and processed products. We've battled in one area of our fund in particular, in the beverage side. If I look at an area that's been our negative, detracted from performance, it's been kind of in that staples beverage side. And yet we still own we own a number of companies in that area because we think in those particular companies, those structural shifts are actually less pronounced, and that there's a bit more of a cyclical impact, which we think will play out in our favor. So just 1 or 2 slides, and then we can take some questions. I spend a lot of time thinking about portfolio construction. So my job as fund manager, obviously stock picking is a big part of it, but then making a coherent portfolio which can grind out strong returns over the long term is really important. And the top left-hand corner of this slide is kind of our go-to long-term core bucket of the portfolio. There's more than just this number of shares in there. This is a bit of an edited highlights package, but all of these shares have been represented here for, certainly 4 or 5 years. And in the funds, this little squiggle here is AstraZeneca. That's that oncology pharmaceutical drug pipeline that we feel is interesting. But Quanta is an electrification trade. And then Broadcom. Broadcom is, I call it our kind of NVIDIA's forgotten cousin. If NVIDIA is the brain of new tech and the AI language models, Broadcom, in my language, is the cardiovascular system that moves the blood around. It's all the switches and leads, as well as being a competitor in some ways in custom chips for NVIDIA. And we've been owner of Broadcom for a long period of time. My job really has been, as fund manager, more cutting exposure and trimming exposure, and I constantly have to do that. We've had great success in these core companies, but we trim and add based on price opportunities given to us by the market. Top right-hand corner, ugly ducklings turning into a swan. These are companies that might not meet our quality criteria in all facets, but generally really good businesses. They might have a weak performing division or might be price takers. In some cases, a bit more cyclical. In the case of CRH, this is an aggregates business, or Coke bottler, which is kind of asset heavy, Mexican Coke bottler. But all of these businesses actually we've owned, again, for a long period of time. We're a bit more ruthless about cutting them when we feel that they've done well, and possibly adding them or peers when there's opportunities that present. And then the bottom left-hand corner of the fund, at the moment, it's about 23% of the fund. It's probably as big as it's been. And that's, I call it the rent part of the portfolio. These are businesses that if I go to a desert island for a week, I would be panicking about, because they are vulnerable to macro inputs. They've got no pricing power. They might be well managed within their industries, but they typically exhibit little quality about them, often have poor returns through the cycle. But they play an important role in the portfolio in various times. As I said earlier on, the yield curve itself is giving us an opportunity in financials. The energy shares themselves often hedge geopolitical risk. And then a company like AngloGold provides us also with risk mitigation. Portfolio performance has been decent. It's important, we are obliged to show the 10-year returns of the Thornbridge Fund that we've been appointed to manage only since November 2022. So that's important for you to know. And this performance predates us, but the performance since then is there for you to see. And again, I'm often asked the question, have you just had this performance with a lot of tech in the company, actually, or in the fund? Actually, we've had significant underweight in technology shares and in the Mag 7, and yet through this period actually done well, I think, not to detract at all from performance. And in fact, to add a little bit of performance as shown here. And our outperformance has really come from the balance of the portfolio and stock picking out of that. So I'll stop there, Eugene, and happy to take some questions.
Bob, that last slide, very interesting indeed. And I think you did answer one of my questions. It was exactly that. I mean, looking at your performance and looking at your holdings, I struggle to make sense of it in my mind. But I think you clarified a lot of that. Just quickly back to commodities. I mean, you've shown under your thematic holdings, you showed Anglo Gold. This wouldn't be an investment conference if we don't touch on currency. Given the weaker state of the dollar, I mean, it's been positive for commodities. Your views just quickly on the dollar. Do you think it's going to remain structurally weaker? And what does that mean for commodities? Are we seeing potentially another super cycle on commodity prices? And are you considering an increasing exposure to commodities? Well, that's three questions.
Whenever I'm asked about the dollar, I always think weak against what? Because as I said, like the euro, the euro itself, I joke about it as the economic museum. I mean, you know, when you stick all your money in what's going on there, the yen, again, it's not an easy place to go. The Chinese renminbi is managed, got some big structural issues. So that's, I think, the good reason to hold a diversified underlying basket of hard assets, including commodities, and including precious metals. And it's the reason that fundamentally attracts us there. I think in the short space of time, it's not a surprise to big players in the markets that Donald Trump has shaken the tree on Fed independence. And so, you know, I think you're going to see a trade away from just dollar assets, and it probably keeps the dollar weaker over time. But it did a lot. You know, we probably moved 15% off the lows, or 10 or 15% off the lows against the euro. And so I'm not a panicked seller of dollars, bottom line. You know, I kind of feel in the absence of something really drastic happening at Fed level, you know, I think the dollar sort of maybe ends at 120 for the year, something like that. And you know, but that's my best guess. I'm not good at that stuff.
And now, with regards to commodities in general, can we see that commodity prices are going to remain stronger, perhaps?
It's a wrestling match between those points that I made and industrial demand. So I think for copper prices, copper market, we feel pretty constructive. There's this whole electrification trend actually that spurs demand for underlying copper usage. Precious metals themselves, I think, are not just gaining value for gold, but also we've seen that in platinum and some of the PGMs being kind of becoming a substitute, even silver becoming a bit of a substitute in the precious metals trade. So I would focus on those sort of areas. I think bog standard iron ore and some of the industrial bulks, perhaps more challenged by a slowing kind of global outlook, and you'd need real stimulus, more rate cuts, and kind of a renewed cycle to get really excited about that. Also, the supply picture there is not as optimistic, I think, for prices. There's quite a lot of supply coming on in iron ore.
Rob, you always suit your investors very well, and it's very interesting to see what you are doing with this mandate. We will obviously include you in a lot more sessions to come for continuous updates. But thank you so much for joining us this morning and for your time. We're very grateful. Thank you.
Great pleasure. Thanks for hosting.
Right, for our last session of the day, and we are stretching time a little bit, and I do apologize for that. My privilege to always welcome Simon Raubenheimer from Contrarians, all the way from Jersey. And Simon, we seem to keep on doing this to you to give you one of the last slots in our sessions. How are you keeping?
That's all right. Thanks, Eugene. Good morning to you and good morning to your audience. I really enjoy these conferences, and we appreciate the opportunity to present and hopefully add to the dialogue.
Simon, just looking at your fund, and I mean, we've been following your story very closely for the past 3 odd years plus. Every time I present to the conferences and on these webinars, and if I look at the performance on your fund, long-term performance right up there, towards the middle of the year, April of the year, there was a couple of bumps in the road. I don't know how to phrase it better. But if I look at your last month's returns, it just shot through the roof. It will be very interesting to see what's working in the fund and with times perhaps not.
Okay, well, thank you, Eugene. Thanks for the opportunity. And maybe let's start with exactly your point on performance. Should we maybe jump straight into our first slide there? We normally like to talk about performance. I mean, it's our bread and butter. So this red line here shows the MSCI World Index since we launched our funds. And you can see, despite all the turmoil over the last 16 and a half years or so, the World Index is up sixfold. And this shows why we love equities. You know, we long-term investors, and we think that equities will continue to create real wealth for their owners over the long term. The next line shows the value index, which is up about fourfold. And the next line shows the growth index, which is up around eightfold. Now, that disparity between value and growth is actually pretty unusual. For most of history, value has actually outperformed growth, with the clear exception of the late 1990s. The next line in black shows the average manager. And as you can see, the average manager performs pretty much in line with the value index. That's not because the average manager is a value manager, far from it. It's largely because of fees and because of the fact that the average manager would typically chase historic winners. So they underperform the broad average by 2 to 2.5% or so per annum. The next line shows point to point is our in dark blue there are our returns. And you can see that we've performed, so from the beginning to the end, point to point, in line with the growth index. But as Eugene correctly pointed out, it's come with some volatility. Now, to be fair, you know, a lot of that volatility was during the COVID period. And although we regret the 2020 drawdown, we are pretty satisfied with our long-term returns. As a small manager, we live and die by our performance. So we are absolutely laser focused on picking the right shares and on picking the combination of asset classes that will result in the best long-term returns for our clients in both our equity and balanced funds. The next slide, Dan, shows our top 10 shares at the end of July, ranked from largest on the left to smallest on the right. Now, our fund is fairly concentrated. So our top 10 shares make up about 55% of our fund, which is pretty normal. The largest shares in our fund, which are Tesla, Warner Brothers, and Paramount there, make up about 9% of the fund each. Whereas Micron on the right, the smallest share in our top 10, made up about 3.5% at end July. Now, what we show here on this slide is how far away from their peaks our top 10 shares are. 7 of our top 10 shares are a long way, as you can see from their respective highs, and are currently extremely out of favor with investors. Across our top 10 shares, and that includes the 3 shares that are at their all-time highs, the weighted average drawdown is 50%, which means that our shares on average would have to double to get back to their highs. Now, this needs to be seen in context of a market which is basically at an all-time high. So we are happy to own beaten down cheap stocks, but we're also equally happy to own fast-growing disruptors that are trading at their highs. And I think that flexibility is what makes us different. Value is not necessarily low PE or low price to book. Some of our best investments have been high PE shares that have continued growing, and some of our worst investments have been low PE shares whose businesses kept deteriorating. If we turn to the next slide, this again shows our top 10 on the left, but now we compare it to the MSCI World Index in that middle column, and the MSCI, the MSCI Value Index in the middle column, and the MSCI World Growth Index on the right-hand side. Now, we don't actually look at the indices at all when we construct our portfolios. If there's an overlap, it's purely coincidental. At the end of July, NVIDIA and Tesla were in our top 10 and were also in the Growth Index top 10. And one share, Meta, was in our top 10 and also in the MSCI World Value Index top 10. So let's quickly run through these shares. Warner Brothers Discovery and Paramount are going through a transition away from linear legacy TV toward a streaming world. Profits are depressed, but they're currently making very good quarterly progress toward their streaming futures. The businesses we think are in about mid-single-digit multiples on what we think normalized earnings are, or normalized free cash flows are. And interestingly, management are doing a number of things to unlock value. So for example, Warner Brothers will be split into two businesses. One is a legacy business, and one will be the fast-growing streaming and studios business. Similarly, Paramount has just merged with Skydance. And actually, we think the sector is ripe for further consolidation. Kering is the holding company for several luxury goods brands, including Gucci, Yves Saint Laurent, Balenciaga, Bottega Veneta, etc. Kering trades on 7 times what it earned in 2022. Similarly, Swatch is a holding company for high-end timepieces. Those brands include Breguet, Blancpain, and Omega. Now, Swiss luxury goods companies are going through a cyclical downswing, driven by subdued Chinese spending, high interest rates, pressure on household incomes, and tariffs in the US. Swatch trades at just over half of the value of its inventory and net cash and properties. So you basically get the operating business for free, or for less than free, actually. Alibaba is a Chinese e-commerce, cloud, and AI business that trades at probably a 65% discount to where it would be trading, were it a US company. It's one of several Chinese companies that we actually like a lot. Baidu is now also in our top 10 and has more than 80% of its market cap in net cash and in liquid investments. And again, you're almost getting the core business, which is search. It's the Google of China, and the cloud business for free. TSMC is an incredibly high quality company. It's Taiwan-based. It's a pure play semiconductor foundry. It's by a long way the largest in the world. It's got over 65% market share. It's on around 19 times free cash flows, which we think is attractive for a company that produces arguably the most cutting edge technologies in the world today. Micron focuses more on memory and storage, with memory chips having become critical for data processing. It's on around 14 times free cash flows, and we think it's got great runway ahead, especially in high bandwidth memory, which is used in machine learning. Demand for high bandwidth memory basically doubles every year or so, year and a half. Historically, semiconductors used to be very cyclical. So one needs to be pretty careful. That said, as the chip sizes have gotten smaller, the manufacturing process has become much, much more complex and capital intensive. And a lot of the competition has actually gone under. And there are basically only 3 large companies left, of which Micron is one, SK Hynix is another that we also like. And those would be the 2 leaders. Meta, we all know it's on about 18 times or so forward earnings if I exclude the losses from Meta's Reality Labs division. In addition to those moonshots, there's also a tremendous amount of fat in these large tech companies that could be cut overnight without really affecting the businesses. The billion-dollar question, of course, is what future return these companies will generate on all the capex that they are currently spending. If you look at our August top 10, which is now up on our website, you'll notice that Micron and Meta are no longer in there. Now, our growth shares, which are Tesla and NVIDIA, are controversial. And have been since we added them to the funds. They've actually been great shares. We bought Tesla back in May of 2023 when the share was trading at around $175. It's now at $330. And we bought NVIDIA this year in March and April at between, let's call it $100 and $120 a share, after a massive pullback when if you recall, the Chinese sort of DeepSeek launched, and NVIDIA now is back at $170. So they've been good investments, but let me maybe touch on those in a little bit more detail again. The next slide shows this is the public perception of Elon Musk. This is what the market sees. Now, unfortunately, all of us read the press and are led to believe that Elon is just the most terrible human being alive. A Media Research Center report earlier this year, interestingly, found out that 96% of Elon Musk's press coverage was negative. Now, admittedly, the study covered a fairly short space of time, but anecdotal evidence would certainly seem to support those assertions. The media is incredibly biased. Most of the reports are sensationalized, exaggerations, or just complete fabrications and distortions. So you have to read what you read with a large pinch of salt. The next slide, I mean, I'm probably first to admit that Elon is a very peculiar person, and his politics may be very polarizing. But whether you love or hate his politics, it's astounding what he has created. Normal, well-balanced people don't go on to change the world. SpaceX, Neuralink, Tesla, Grok, I mean, what he's doing at Twitter, each of these businesses is incredible in its own right. I think objectively, he has to be one of the most impressive business people of our age. Tesla is far more than a car company. Tesla is building out an artificial intelligence infrastructure which will power autonomous cars that drive themselves, fleets of robo-taxis, humanoid robots, and energy storage. This image here shows it quite nicely. In fact, in our valuation for the business, Tesla's legacy car operation actually makes up a pretty small part of the overall valuation for the group. This future is actually not that far away. Tesla has already solved self-drive. So as we speak, Tesla's cars are driving around Austin, Texas, and San Francisco with no one in the driver's seat. Tesla's approach to full self-drive is very different to its largest competitor, which is a company called Waymo, owned by Alphabet. Waymo relies on cameras, plus LiDAR, plus radar sensors, plus thousands of lines of code, plus high-definition maps. The problem is, well, firstly, it's not scalable, okay? So it only works in geo-ring-fenced areas. The first commercial Waymo was launched back in 2018. 7 years later, Waymo has fewer than 1,500 cars on the road. The second problem is that it's expensive. So current Waymo would cost you probably $180,000 each. Tesla, on the other hand, bet early on AI. Okay, basically cameras that feed video imagery into a brain and then uses artificial intelligence to train itself to drive. Tesla self-drive is actually the largest real-life AI project in the world today. The advantages are, well, it gets better and better over time as it learns, okay? It's also a lot cheaper, right? So Tesla can produce these cars for probably $25,000, maybe $30,000 each. It's also infinitely scalable, okay? There are over 2 million Tesla cars on the road in the US. Almost all of them are equipped with the necessary hardware to drive themselves. And Tesla builds more than 5,000 of these cars every day. Once Tesla gets regulatory approval, all it takes is a simple over-the-air software update, and Tesla will overnight have the largest fleet of autonomous cars in the world, in the US, sorry, with a 99.9% market share. Slightly further out is Optimus, which is Tesla's humanoid robot. There is no doubt that our future will be shaped by robotics. Robots are becoming more adaptable, more autonomous, more collaborative, and they will work alongside us. Generative AI is actually making robots massively more capable and cost-effective. And we believe Tesla is a market leader in this space. The net present value of Tesla's robot business could actually be bigger than all its other businesses combined. So we think that's a very valuable option. Which brings me to NVIDIA. Next slide. How is NVIDIA contrarian? Well, firstly, remember that we bought NVIDIA way below where it's currently trading. The mainstream likes NVIDIA for its data center business, which admittedly is a great business and is sort of 90% of current revenue. You've probably seen a version of this chart 10 times already. This is how much the hyperscalers are spending on CapEx. Now, most of this is on NVIDIA chips, and we keep having to update the 2025 number up. In NVIDIA's latest results last week, Jensen Huang said that he expects between $3 and $4 trillion of CapEx over the next 5 years, with NVIDIA potentially capturing up to 70% of that. These are not our numbers, by the way, but NVIDIA is growing revenue at almost 60% still year on year, which is absolutely astonishing. And that's at, sorry, more than 60% operating profit margins. The next slide. The reason we like NVIDIA is because it has to do with real world AI. So in the future, everything that moves will move autonomously and will have some sort of intelligence. I've spoken about autonomous cars already. Our next generation of children probably won't be learning to drive other than as a hobby. You can imagine the impact on productivity if you can collaborate with an AI agent that can make decisions and perform tasks autonomously, help your kids with their homework, or even displace teachers altogether. Just read up on the alpha schools in the US. The breakthroughs in healthcare are already astonishing. If I take, for example, radiology and pathology, I've seen studies comparing the outcomes of doctors with AI versus doctors without AI versus AI alone, i.e. no doctors. What's maybe not surprising to anyone anymore is that doctors who don't use AI are right at the bottom of that pile in terms of diagnostic accuracy. What was surprising is that AI alone is now actually doing better than doctors with AI. And AI is only getting better. In manufacturing, companies are now building digital twins of their factories, basically a virtual replica of that factory or manufacturing process. This enables companies to do real-world, real-time testing and data analytics to optimize efficiencies and manufacturing efficiencies without having to do costly real-world trials using their physical equipment. And soon, every factory in the world will have a digital twin. NVIDIA is already partnering with companies like Siemens, General Motors, Pizza Hut, KFC on doing all sorts of things. And the company's on about 30 times forward earnings. So that's to their next financial year on consensus forecasts. The high PE unwinds quite quickly, actually, given the rapid growth rate. And we think there'll be a tidal wave of physical AI products and services that'll be unleashed over the next few years. Real-world AI companies like Tesla and NVIDIA are going to disrupt the business models of many companies and even entire industries. Picking the winners will be difficult because things change so fast. Equally important, I guess, will be avoiding the losers or the value traps. And we'll probably change our minds often as we progress. Fortunately, as a small manager, we can move between companies quite quickly and seamlessly. My last slide just shows the weighting of our fund versus the index from a geographic perspective. Now, despite the fact that the US, as you've seen on previous presentations, appears more expensive on historic metrics, that's where the earnings growth has been. And we think will continue to be for the foreseeable future. If we take industries like e-commerce, social media, cloud compute, autonomous driving, robotics, AI, etc. But then also, if you exclude the MAC 7, the US has actually underperformed many other developed markets over 1 year, 3 year, 5 years. So we still see tremendous opportunities in the US. And of course, the other part of the world that innovates very rapidly, and we've had presentations on that, is Asia, specifically China. And that's actually probably now our largest overweight position on a relative basis, as you can see from this slide. We are finding a lot of value there, but one has to tread very carefully given the geopolitics. So I'll maybe leave it at that, Eugene. I don't know if there are any questions.
Simon, thank you very much for that, and very interesting on the AI as well. And we're very glad that Dan is hosting that session tomorrow, that we can all embrace AI a little bit more.
Yeah.
Simon, just quickly, on some of your holdings, if I look at, again, just the line graph and some of the shares that you hold, You've got a very high up capture ratio. So if it's recovery in shares, I mean, and you see it in your numbers as well. But you also have a high down capture ratio. So my question almost speaks to your investment process. When you experience these times where companies go through extreme difficulties, or when there's a big sell-off in their price, what do you do with those companies? Do you then double up? Do you rebalance to the holdings or to the ideal splits, or do you ever capitulate on some of these stocks?
Yeah, it really depends on the circumstance. I mean, there are times where we get things wrong, and the minute we realize we got this wrong or something happened that we didn't forecast or predict, we have to be willing to change our minds quickly. And if that means taking a loss, that's obviously a very difficult thing to do psychologically, but we have to be able to do it. We have to be pretty brutal and ruthless and move on. At times, we think the market got it wrong. And those would be instances where we would double down. I mean, volatility, unfortunately, is a sort of a consequence of looking very different to the index, of looking very different to other managers, and of looking very different to the market. A lot of our shares are completely misunderstood by the market. So our returns, and very heavily shorted. So our returns will be massively will be more volatile, also because our portfolios are quite concentrated. And we believe you can only outperform if you look different to the market. If you look the same as everyone else, by definition, you won't outperform. So volatility is almost the cost of admission, so to say. But I think maybe, sorry, Eugene, but the most important message on this is that the longer your time horizon, the less volatility matters. Volatility is only a risk if it results in poor behavior. And if you ignore the short-term noise, then you'll be okay in the long term. And this is why we keep pushing this long-term message, because we think that's absolutely vital to generating long-term client returns. It's no use the fund does well over the long term if the average client in the fund lags by 5 or 6 or 7 percentage points. And we've seen that happen to many managers in the US.
And I think that's a critical point, exactly that. And you bring something very different to the market that you don't normally find in other funds. And over the longer term, I mean, the strategy does work. Simon, again, thank you so much. And sorry for keeping you waiting a little bit.
No, all good.
Great. Yeah, always
thank you very
great.
much, Eugene.
Yeah, fantastic. Thank you so much.
Cheers. Bye-bye. Bye-bye.
To our audience as well, thank you very much for sticking around. It's really great to have you on board. This was the last day of our 3-day Offshore Managers webinar. Next week, we are starting with our live roadshows, starting the 9th of September in Durban, followed by PE, then 16, 17, 18 in Pretoria, Joburg, and Cape Town. Looking forward to seeing you at the live events. I mean, you can also have some opportunity to engage with some of the top fund managers across the globe and in SA. The BCI team, Olga, Tanya, thank you so much for all these sessions, all the hard work you put in. Dan, Excel Academy, a lot of us are going to see you tomorrow again. So thank you so much for driving all of us to the back. And most important, to our supporters, you, the audience, thank you so much. We're always grateful for all your support in making BCI a great success. Thank you so much.